But, you know, what Ron Colella was always going for was beauty as a paparazzi photographer.
And we mentioned the Babe Ruth. This is Babe
Yes,
Ruth, number 3.
Yes, that is phenomenal. From behind to see the number, and Nat Fine won the Pulitzer Prize for that picture.
It's 11 a.m. in New York, 4 p.m. here in London, at midnight in Hong Kong. There are 30 minutes left in the trading day in Europe. I'm Naira Chahich, in for Mark Barton.
And in New York, I'm Vonnie Quinn. This is the European close on Bloomberg Markets.
We're going to take you from New York to Zurich and cover stories out of Greece, the UK and Wall Street in the next hour. Here's what we're watching. Shares of Europe's largest biotech firm jumping after Johnson & Johnson approached the company for a potential takeover. More on this potential $17 billion tie-up ahead.
Technical indicators show the biggest treasury market sell-off in 7 years is coming to an end. So why are markets ignoring those signs? We'll talk to a fixed income investor next. And the holiday shopping outlook. Target CEO Brian Cornell just telling us his company has the advantage over Amazon because of its physical stores.
Well, let's have a look where European equities are trading right now. We're just under 30 minutes to the close. I've got the cross-asset picture here for Western Europe looking at GMM. If you look at what equities are doing, Switzerland's SMI up 1.1%, one of the best performers today in Western Europe. Portugal higher, the PSI 20 up 0.5%. Gains in Luxembourg, Denmark, Belgium as well. If we look at the FX space, a lot of it's about a weaker dollar story today, even though we've had a stronger dollar story, of course, for the past couple of weeks. weeks. The euro up 0.5%, 106.06 on that. We're seeing the Swiss franc up 0.3% as well. The dollar basically pairing a weekly advance. The Bloomberg dollar index, in fact, falling from a decade high. In terms of what's happening in the fixed income space, we're seeing 10-year yields coming down in the periphery, down 8 basis points here in Portugal, and also down 5 basis points there in Italy. We're also seeing the 10-year yield coming down on the German Bund. And in the commodity space, we're seeing an interesting picture here because we're seeing a weaker oil price around those concerns that there isn't going to be a deal reached perhaps at the OPEC meeting on November 30th. Brent crude down 2.7%, 47.66 a barrel. A bit of a mixed picture in the metal space. In terms of what's happening with European stocks, though, so the Stock 600 pretty much unchanged right now. We're up just 0.1%, but it is near a one-month high. It's also set for a third weekly gain, which would be its longest streak of weekly gains since July. All this, by the way, bear it in mind that the trading volumes are lower than the 30-day average, around 40% lower. In terms of what's happening in the sector space, a little bit of a mixed picture here. We're seeing healthcare stocks leading the gains. I'll come on to that a little bit more in just a moment. Energy lagging with the weaker oil price down 0.7%. We're also seeing materials, which includes the commodity producers, off by 0.2%, and financials underperforming as well. Now, I wanted to bring up Actelion because what we've seen is these shares absolutely spiking today, hitting a record high. And we've got some breaking news that Actelion has actually confirmed the approach by Johnson & Johnson about a possible transaction. Now, we've seen shares of Actelion soar by the most in more than 2 years today on speculation of that takeover bid, but we do now have that confirmed from Actelion. Vonnie?
Nera, thanks. Let's get a check now on the US majors and the details of what's going on in the US market. It is a shortened trading day, Abigail Doolittle, but nevertheless we have some trading today.
That we do, Vonnie. We have, in fact, record highs for the major averages here in the U.S. Once again, the Dow, S&P 500, and NASDAQ are all on pace right now for record highs. For the Dow and the S&P 500, this would be the fourth record close in a row and the longest streak of record closes since 2014. So some real strength there. As for the Russell 2000, even more strength. Right now we do have the Russell 2000 up for its 15th straight day, the longest winning streak since 1996, and on pace for a record close, the 9th in a row. So again, some real strength here for U.S. stocks. As for what's leading the charge today from a sector standpoint, we're looking at a lot of the rate-sensitive sectors, including utilities, telecom, and real estate. All of these indexes, S&P sector indexes, are trading higher on the day. What could be happening here is the fact that we have yields, rates, basically on pause, up ever so slightly. Of course, this could make the high dividends for some of the stocks in these indexes look a little bit more attractive. Now, these stocks may look more attractive on the day, but one thing that looks less attractive for the utilities valuation. Let's hop into the Bloomberg and take a look at G#, BTV 5116. And this is a chart going all the way back to 2009. And in white, we have the utility index. In blue, we have the 10-year yield. And we see that when the yields drop, that these high dividend stocks do become more attractive to investors. They bid them up. And then the inverse happens, as has happened recently with rates rising and the utility index coming in. Now, interesting here is the point on valuation. Down here we have the price to earnings ratio. We see that it is well above 15, pretty high for these defensive stocks, perhaps suggesting that maybe some more weakness could be ahead for utilities. And finally, just to round it out on this Black Friday with some retail stocks, we are looking at ever so slight gains for Amazon. We're basically not having a big reaction on Black Friday for these retailers, but we do have Amazon, the e-commerce giant, that did report record sales of $2 billion on Thanksgiving Day itself. The one stock that's up slightly, while Macy's, Tiffany, and Kohl's are all trading down slightly. So, Vonnie, it appears that e-commerce right now is beating bricks and mortar.
All right, Abigail, thank you. Still a couple of days left in this long Black Friday weekend. Let's check in now on the Bloomberg First Word News. Eric Johnson has more from our London newsroom. Eric.
Thanks, Vonnie. The president of Turkey is threatening to reopen the borders and flood Europe with millions of migrants. Recep Erdogan was reacting to a vote in the European Parliament. Lawmakers called on the EU to suspend Turkey's membership talks because of the crackdown following that failed coup. Erdogan says Turkey is feeding more than 3 million refugees, and if the EU goes further, he'll let them leave for Europe. A prosecutor in Paris says 5 men arrested on Sunday were planning a terrorist attack in France as early as next week. He said the suspects were getting their orders from an Islamic State member based in Iraq or Syria. The 5 were arrested in Strasbourg and Marseille. Fires in Israel have forced thousands of people to flee their homes. Hardest hit was the city of Haifa, where some 50,000 people were evacuated. Israeli leaders raised the possibility that Palestinians deliberately set the blazes. Police have arrested 13 suspects. Meanwhile, Israelis have accepted offers from Egypt and Jordan to send firefighting help. A judge has found the suspect in the deadly Charleston, South Carolina church shooting competent to stand trial. Jury selection in the trial of Dylan Roof starts Monday. Roof is accused of killing 9 churchgoers after a Bible study class last year. The government of Colombia has signed a revised peace treaty with Marxist rebels. That took place almost 2 months after Colombian voters rejected the first agreement. The deal is aimed at ending the 52-year-long civil war that's killed more than 200,000 people. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Eric Johnson, and this is Bloomberg. Neera.
Thanks so much, Eric. Now, the European Central Bank's Governing Council will have to decide on December 8th whether to extend its $1.8 trillion QE programme beyond the current March deadline. As of now, there appears to be little appetite for tapering. Bloomberg's Guy Johnson spoke about it with Yanis Stonaras, ECB Governing Council member and also Governor of the Bank of Greece.
Monetary policy will continue to be accommodating until inflation arrives at the desirable level, which is 2% or slightly lower.
But now is not the time.
There's still a long distance from this target.
So far too early to be talking about the T word, the tapering word.
It's far too early, exactly.
Joining us now to discuss the outlook for Europe as well as the US is James Athay. He's a fixed income investment manager with Aberdeen Asset Management, which has more than $402 billion under management. James, you heard the sound there. Is it too early to be talking about tapering?
I guess that it depends on what you mean by too early. Economically speaking, absolutely. You know, the ECB is still a long way from fulfilling their mandate. But as we know, that's not really the end of the discussion or the debate here, because actually what we're probably questioning is just the effectiveness of the policy. So it's interesting to hear the terminology that's used by different governing council members that probably sit in different places on the hawk-dove spectrum, and they're all quite guarded in terms of the language they use, but there's no consistent picture emerging from what I hear. There are enough uncertainties to make me think that there are conversations about whether or not they can just continue with this pace of bond buying, because there are technical constraints, and to be honest, there's very little evidence that this is actually doing what it sets out to.
Now, what's made, I guess, their job a little bit easier post the US election is that we have been seeing this backup in yields in Europe as elsewhere around the world. How do you think the discussions are going to play out at this meeting that's coming up, you know, with all the challenges, of course, that are facing Europe? Because according to you, it's a mess.
Yeah,
and
absolutely.
What are the risks of it not giving the ECB, not giving this dovish tilt? We don't want a repeat of December 2015, right?
I think that's a huge risk. Even if they don't taper, even if they extend the programme, I still think there's a chance that the language which Draghi is forced to use because of the various opinions that are on the committee gives the market that little hint that actually, rather than maybe QE infinity, which implicitly I think a lot of market participants probably were expecting, we are talking about QE with some sort of definitive end date, and that might be sooner than market was expecting. I mean, you say that the rise in yield has made their job easier. In a sense, it's complicated it because the market impact of them telling us that they're going to taper now would be hugely magnified by virtue of the fact that what's happening in the US has sort of unleashed the bond bears. They've been hibernating for quite a long time. They've been frustrated for quite a long time. Suddenly they've got, the bit between their teeth, and we're seeing that in price action. If the ECB were to double down on that right now, that could see some really dramatic moves.
So I'm curious as to how the ECB will be talking about the Italy referendum. If Italy votes no for constitutional changes, does that mean that we might be looking at an exit scenario?
When you say an exit scenario, Vonnie, do you mean as in Italy exiting from the Eurozone?
Yes.
Yeah. There are so many possible scenarios with respect to the Italian referendum. It's really difficult to come up with even a sensible base case. There is definitely a route that could lead towards, further breakup fears, and we know they can quickly become quite self-fulfilling via market pressures. I can't think that has to be the base case for the near term. Basically, even if there were to be an election, even if that were to lead to the five-star being the majority party, it's still not entirely clear that the lower house reform, which is currently being debated by the Constitutional Court, would stand, and if so, you would end up still with a situation where, while they were the dominant party, they didn't really have free rein to do exactly as they wanted, and actually there are legalities with respect to even a Eurozone referendum within Italy, whereby there is potentially a situation where they have to have a referendum to decide if they can have a referendum on the Eurozone. So Italian politics being Italian politics, I'm afraid it's probably going to be quite complex and messy for a period.
Yeah, well, there's that, and then there's also the former Prime Ministers, Tony Blair and John Major, weighing in on the fact that there doesn't have to be a Brexit. So just how much in disarray is the current ECB, or are they putting all of this political, interference out of their minds?
Yeah, I'll leave the sort of Brexit question, because I think we've probably done that idea of Brexit not meaning Brexit to death, but it's obviously hugely difficult. We know that. Monetary policy has been under huge pressure globally for a good number of years now, and nowhere has that been more acute and more troublesome than within the Eurozone. We know why that is. We know the politics that underlies this problem. We know the geographical splits, the very different economies. Germany running 8% current account surplus, the pressures that those imbalances put on the whole system, and therefore the difficulties of setting one monetary policy for the whole region. This story's been around since well before 1999, and all we're seeing now is it playing out in real time. How the ECB manages the politics versus the economics versus the reduced pressure for reform which comes from their QE policy, it's very difficult to say. But based on what Mario Draghi didn't say at the last press conference, based on what we've heard from other governing council members in the meantime, I certainly fear that we are heading towards a change in ECB policy stance going forward, and that's going to lead to some volatility in markets.
Just to bring you back to what you said earlier, where you said if the ECB doubles down, we could see some really big moves. Just what kind of moves are we talking about? Put some numbers on it for me.
Wow, that's a good question. With Italy already trading at, closing in on 200 over bunds already, if we were to see no result in the referendum, and then the ECB tapering or talking about tapering or sounding a little bit hawkish, would it surprise me if Italy traded a lot wider, 100 wider than where it is now? I don't think it would, no. So the Bund is a tough one. Does it sell off because there's less bond buying, or does it rally because there's a flight to quality, because there's pressure in the periphery? It's difficult to really come up with a solid base case there. It does feel that German 10s, 30s would steepen because that's been flattening because of the hunt for yield, because of the ECB bond buying. So there's an awful lot of different moving parts, and some of them are pointing in the same direction and some of them maybe not. But Italy and Spain have definitely been big beneficiaries of the policy, so you'd expect to see some stress there.
Just a really quick question on treasuries, because we've looked a lot as well at that widening spread between treasuries and bunds. If you look at the term premium, it suggests that treasuries are fairly valued right now. Where do you see the 10-year yield going, given where we are now?
Yeah, it's a good question. Actually, I think the story has been a little overplayed with respect to the drivers of treasuries. If you look at the front end, I think what we've priced is what the Fed was telling us they were going to do anyway. So if that's the case, and we are going to see some pro-growth policies from Trump's presidency, I still think there's upside on the 10-year Treasury yield. So going forward, I definitely would expect to see bigger moves up in yield than I would down.
James Athey, bigger moves up than down in yields. Fixed income investment manager with Aberdeen Asset Management. Thank you so much for joining us on the programme. Vonnie.
Nira, thanks. We have breaking news now from President-elect Donald Trump's transition team. Bloomberg has learned that the Trump team is set to name Katie McFarland as Deputy National Security Advisor. General Michael Flynn had already been named National Security Advisor. Ms. McFarland served in the Nixon, Ford and Reagan administrations and is a life member of the Council on Foreign Relations. She also made a run unsuccessfully to win the Republican nomination for a U.S. Senate seat for New York back in 2006. We learned earlier as well from the transition team that Trump will name 2 staff-level appointments today. Once again, Katie McFarland, Deputy National Security Advisor. This is Bloomberg. Live from London and New York, I'm Bonnie Quinn.
And I'm Naira Chahich. This is the European close on Bloomberg Markets with about 15 minutes to the end of equity trading.
Well, it's time for the Bloomberg Business Flash, the latest look at some of the biggest business stories in the news right now. European Union regulators are in settlement talks with banks suspected of rigging currency markets. That's according to people familiar with the case. It's all part of an investigation that's already led to multi-billion-dollar fines in the US and the UK. Barclays and HSBC have previously said their currency trading was being reviewed by the EU. They're off and shopping. Millions of Americans have begun buying gifts for the holidays. Walmart and Target are trying to keep up with Amazon, so they're counting on heavier discounts and a bigger online selection. Earlier, we spoke with Target CEO Brian Cornell.
Well, we want to make sure it's really easy for our guests to shop our brand any way they want. So yesterday was a really big digital day for us. In fact, it turned out to be the biggest day in our company history.
According to the research firm Market Track, which looked at holiday circulars, Target's average price cut has grown from 36% last year to a cut of 38% this year. And that is your Bloomberg Business Flash for this hour. Coming up, shares of Swiss drug maker Actelion are soaring today on news of a takeover. We'll dig into this potential $17 billion tie-up. This is Bloomberg.
London, I'm Naira Chahich, counting you down to the European close. We're just about 5 minutes away.
And from Bloomberg World Headquarters in New York, I'm Vonnie Quinn.
Shares of Swiss drug maker Actelion are soaring today, hitting a record high, in fact, this after Johnson & Johnson approached the company about a possible takeover. Joining us now is one of the reporters who broke this story, Manuel Baigorri of Bloomberg News. Manuel, give us the latest. Good to see you, by the way, because I believe that Actelion have now confirmed the offer, right?
Exactly, just moments ago. So we did a story last night, yesterday evening, and it's a really fantastic story. One of the most successful biotech companies in Europe, the biggest one, and it just received another approach. It's been a long story of back and forth with potential suitors. Even an activist investor a few years ago tried to force the company into a sale process, but it didn't succeed. Let's see if this time around Johnson & Johnson makes it happen.
What's different this time round?
Well, the company has grown over the last 10-15 years dramatically, exponentially, and the CEO and the founder, the same person in this case, is very attached to the company, and he's always very reluctant to sell the company. He's very attached, he's a scientist, he really believes in the growth of the biotech industry. And this time around, though, I mean, you just made a great question, why Closell would be willing to sell now. If you look at the pipeline of drugs at the company, there are clear symptoms that it could be drying up, and it could be a really good window for him to step aside and let other drug makers to take the next level.
Well, if indeed Actelion was absolutely, convinced that they didn't want to sell, what kind of techniques could they employ in order to get out of this mess? Can they find a white knight? Is there any kind of poison pill strategy that could be invoked?
Yeah, that's a really great question. I mean, I am sure that other drug makers on top of J&J will be looking at this situation closely, monitoring, analyzing whether or not it makes sense for them to make a move, both in Europe and across the pond in the US. It's a very well-known hot biotech stock, and I wouldn't be surprised if others try to jump into the fray.
What about generic competitors to Actelion? Does all of its drugs, does all of its portfolio have a long run time before we need to worry about generics and things like that?
Yeah, that's a really good point as well. I mean, actually, the company is facing a sleep product next year, and that is one of the reasons why, it might be a good time for the founder and CEO to explore a sale. I mean, he's come across great success. He's built an amazing company, but challenges remain ahead, and it could be for those reasons, it could be a good moment for him to actually potentially sell the company.
Bloomberg's Manuel Baigorri, thank you so much for breaking down the big deal of the day for us. Now let's take a look where European markets are trading as we head to the close. The Stoxx 600 near a one-month high, up 0.2% there. The FTSE 100 pushing ever so slightly higher. We're flat on the DAX, ever so slightly higher on the CAC 40. A little bit of thin trading today, by the way. Volumes are down below their 30-day average. Let's switch up the board and take a look at the FX market. It's a weaker dollar story today with the Bloomberg dollar index falling from a decade high. That means the euro is pushing higher, up 0.4%, 105.98. Sterling pretty much unchanged, 124.54. And if we check on the bond market, it's a bit of a divergence between what is happening in the US and in Europe. Yields up in the US, down in Europe. This is Bloomberg. Live from London and New York, this is the European Close. I'm Naira Chahich with Vonnie Quinn. Stocks finishing up the day in European trading. Let's take you through all of the market action today. I have to say there's been a little bit less action than normal with volumes down below the 30-day average, but we have still seen some movement nonetheless. If you look at the equity indices here on the left on the GMM function, I've got it cross-asset for Western Europe. You're seeing quite a lot of gains. The SMI up 1.1%, one of the best performers in Western Europe today. Gains in Denmark, Belgium, Luxembourg as well. It's a little bit of a weaker dollar story too. The Bloomberg dollar index falling from a decade high, meaning that we're seeing a stronger euro, up 0.4%. We're at 106 exactly at the moment on that. The Swiss franc pushing higher too. Sterling, though, pretty much unchanged today. Looking at what's happening in the fixed income space, bit of a different picture. Whereas we're seeing the 10-year yield in the US move higher, in Europe we're seeing most of the yields move lower. So at the front end here you can see Germany's 2-year down 2 basis points. We're seeing the 10-year bund yield go down too, and Portugal's 10-year down some 6 basis points. We are seeing some moves lower elsewhere in the periphery as well. In the commodity space, of course, a lot of focus on oil with more doubt coming in about that OPEC deal being reached on November 30th. Brent crude down 2.9%, 47.57. If we take a look at how the Stock 600 is closing up, pretty much unchanged, that we are seeing, or we have seen some gains creep in at the close. It's up almost 0.2%, pretty much at a 1-month high, set for its longest streak of weekly gains since July. 3 weeks of gains, that is now, I believe, its longest streak of weekly gains since July. And if we take a look at how various sectors are performing here at the close, so we're seeing healthcare leading the gains, up 1.4%. That largely down to Actelion, which I'll come to in a moment. But we're seeing energy has been underperforming, down 0.7% on that weaker oil price. Financials down some 0.3%, perhaps tracking those bond yields, and materials down too. But overall, a bit more in the green than in the red in terms of industry groups. And then finally, just wanted to bring you to Actelion. So here, this is a 2-day chart. We're up some 19% over 2 days. But intraday, we have seen Actelion rise the most ever and hit a record high as well. This is after J&J was said to make a takeover approach for this drug maker, and Actelion confirmed to say that that takeover approach had been made. Vonnie?
Naira, thanks. Well, I'm taking a look at CMM Go, country market movers, and obviously the US is the focus. You can see that all of the major indices and some of the more minor indices are in the green again today for this Friday session. Not a huge amount of movement upwards, but nevertheless, if you look at the Dow, we're still at 19,135. So holding on to those gains that we've seen since the election. It'll be interesting to see if that holds through the rest of the year. The Russell 3000, the Nasdaq 100, the composite for the New York Stock Exchange, they're all higher today. We're going to look at some currencies that are really interesting in a moment, but just have a look at the stronger currencies versus the US dollar today. The euro, the krona and the New Zealand dollar. So some commodity currencies, but also obviously the euro, which is having an impact here on the dollar index, particularly DXY, which we'll look in a moment, but also the Bloomberg dollar index, which is a more varied basket of currencies, 10 currencies, and it's rebased every year. All right, well, we'll have a look at currencies right now, shall we? The dollar index, as I was saying, it's primarily against the euro and the yen. They have the biggest weighting in that index, and obviously it's at a high, even though it's down a little bit in the session today, 101.43. Look at the Turkish lira. So it had weakened all the way to the point at which the central bank couldn't not act. There was a big movement yesterday, and now it's regaining all of those losses that it had already made. 344 for the Turkish lira. Not a huge amount of movement today, but saw a lot of movement yesterday after that central bank action. Now, the interesting thing is the South African central bank didn't move. It's got a real problem because it's got an inflation problem and a growth problem. So it's sort of stuck between a rock and a hard place. It can't raise and it can't lower rates. So right now it's stuck with a ZAR rate that is not particularly attractive to the South African central bank. We're looking at yields in the US as well. 237 on the 10-year and 114 on the 2-year, making the 2-10 spread 122. And I just stuck in the Italy 10-year yield there because it's a fascinating time to be watching that. Let's move on. First Word News, Eric Johnson has more from our London newsroom.
Thanks, Bonnie. The US and its allies are taking steps aimed at discouraging the incoming Trump administration from abandoning the Iran nuclear deal. According to the Wall Street Journal, they're pushing Iran to reduce its stockpile of radioactive material to well below the level agreed on. President-elect Donald Trump has vowed to either scrap the Iran deal or renegotiate it. China is warning that US Navy patrols pose a threat to its sovereignty and security interests. According to a Chinese government think tank, American ships and planes carried out more than 700 patrols in the South China Sea region last year. China says it's the US's #1 surveillance target. Italy's Prime Minister Matteo Renzi has reaffirmed he'll quit if voters reject constitutional reforms on December the 4th. Renzi told the newspaper La Stampa that a so-called technocratic government would not serve the government well. The Prime Minister has said the reforms will make Italy easier to govern. And it's the final White House Christmas tree of the Obama administration. Michelle Obama was there as the tree was delivered. It's a 19-foot-tall Douglas fir from Pennsylvania. A special election here in London was supposed to focus on expansion at Heathrow Airport. Instead, it's become the first electoral test of how Prime Minister Theresa May is handling Brexit. Conservative lawmaker Zach Goldsmith, who quit May's party to run as an independent, supports leaving the EU. Sarah Olney, a Liberal Democrat who is his main challenger in the by-election, wants another Brexit referendum. The vote takes place next week. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Eric Johnson, and this is Bloomberg. Neera.
Thanks so much, Eric. Now, more signs the UK is weathering the Brexit fallout. GDP grew by 0.5% in the third quarter, a slight slowdown from the second quarter, but still ahead of estimates. Household and business investment spending also edged up. This, of course, comes just days after Chancellor of the Exchequer, Philip Hammond, cut the growth forecast for next year in his autumn statement. Joining us now to break it down is Dan Hanson, UK economist with Bloomberg Intelligence. Dan, what was the biggest surprise here? Was it the business spending?
Absolutely. I mean, business spending, certainly in the UK, is very sensitive to heightened uncertainty, and we're in a period of heightened uncertainty at the moment, and it grew 0.9% on the quarter. Now, the question is, why did it do that? Economists thought it was going to fall. Couple of reasons. One, it may be a lot of these decisions were taken prior to the referendum, even 12, 18 months ago, and it's just showing up now in the national accounts. It may also be the case that credit conditions in the UK have remained relatively loose. The Bank of England have got a lot to do with that. And when credit conditions are loose, uncertainty tends to have less of an effect on investment. There's been some evidence out by Kristen Forbes, one of the members of the MPC, noting that point. And I think that may have something to do with it.
I mean, we keep talking about how Brexit hasn't been as bad for the economy as people expected, but how much longer is this going to last? Because according to a number of forecasts, things are actually going to get worse.
Yeah, I think so. So the uncertainty effect, it may be the case that it just takes time to ramp up. But I think the thing that's really baked in is that we've seen the depreciation in sterling. And what we know is that's going to squeeze real incomes next year and slow consumer spending. So I think a lot of forecasters are moving towards that as their main reason for the slowing in growth this next year, I should say. You saw the OBR this week downgrade their forecast. And that was a dual effect. It was this business investment effect, but it was also that squeeze on real incomes.
When are the most CEOs looking to see a little bit of a reaction in these kinds of figures, Dan? I mean, CEOs are one thing, you know, obviously they're at the cold face, so they can have a different forecast to economists. What are they saying?
Sorry, you'll have to repeat the question. I didn't quite catch that.
CEOs and people at the cold face, where they're exporting and they're importing and they're hiring and capital spending. When do they see a slowdown as opposed to economists?
So I think that's quite an interesting one. I mean, I think people and CEOs, as you mentioned, who are on the front line, see a very different world to macroeconomists like myself. We see things at sort of a very high level. We just look at the macro data. You know, you speak to different individuals, and they do say that they are delaying investment projects. And I genuinely think, you know, it's only a matter of time before we see that show up in the headline macro numbers. I mean, it's worth saying with investment in the UK, it's extremely choppy and volatile. But I think the broader trend will be one of a slowing. And of course, what you don't know as well is the counterfactual. It may be the case that investment would have grown even more strongly had the UK remained in voted to remain in the European Union. So there's that element to it as well.
It seems at least on this side of the Atlantic that there are more and more voices now, high-profile voices like Richard Branson, you know, like Tony Blair, like John Major, coming out and saying that that this doesn't need to happen still, when we thought it was very much a done deal. To you, as an economist, I mean, you can't worry about that when you're forecasting out 12 and 18 months. It's making economists' jobs very difficult in Britain, isn't it?
Oh, absolutely. I mean, one of the things in these uncertainty gauges capture is the dispersion of forecasts. And right after the Brexit vote, the dispersion of forecasts was absolutely enormous. You had economists predicting recessions, you had some predicting just growth slowdowns. There's more of a consensus now, but you know, the numbers today only stand to highlight how difficult it's going to be over the next 18 months and how you sort of firms and companies need to tread with caution. I think it's going to be very difficult to get a handle on how this is going to play out, because there's no real precedent for what's going on in the UK and what the UK is about to go through.
Just very quickly, Dan, the Chancellor's decision to borrow more to spend, is that going to help or hinder growth?
I think on balance it's not going to have much of an effect. The broad picture is that we're still focused on deficit reduction in the UK, but the point to take away is that he has made room to apply fiscal stimulus if he deems necessary. He's got that room to do so if he sees a slowdown coming.
OK. Dan Hansen, UK economist with Bloomberg Intelligence, thanks so much for joining us on the programme. Bonnie.
Well, the ECB is facing a decision, as we've been talking about, Nera, on December 8th as to whether to extend that $1.8 trillion stimulus programme. Some policymakers are now saying the central bank may put off decisions about the future of its bond buying programme until early next year. Bloomberg's Guy Johnson spoke with ECB Governing Council member and Bank of Greece Governor Yanis Stornaris in Athens earlier about the growing tension surrounding rising bond yields and the impact of that bond buying programme.
It is true that bond prices and bond yields have changed. We are entering perhaps a new era. The numbers show that our policy works. Inflation is on the rise, as I said before. Yeah. We look at all this data on the 8th of December and we will decide. I mean, of course, monetary policy will continue to be accommodating until inflation arrives at a desirable level, which is 2% or slightly lower.
But now is not the time.
There's still a long distance from this target.
So far too early to be talking about the T word, the tapering word.
It's far too early, exactly.
One thing we have seen as a result of Donald Trump's election has been a steeper yield curve. Is that desirable in your mind?
From the bank's point of view, it is, yes. I think it is a desirable effect.
Because it helps the banks?
It helps the banks.
But it does raise borrowing costs?
Yes, but if growth also goes up, it does matter. Because now the most important problem is low growth. If growth improves, it is expected that bond yields will be on the rise.
You talk about rising inflation, and even in the 5 years point to the fact that even quite some way out, inflation is not going to get back to target. That's something that the market is pricing in at the moment, and your data seems to indicate, and your forecasts seem to indicate something as well. Janet Yellen talks about running a hot economy. And she has seen this. It'd be interesting to know what she thinks now. But she thinks that overshooting on the inflation story is maybe something that central banks, or her central bank, should think about. Is that something that the ECB can think about as well?
No, not yet. Not yet. The cycle differs now in Europe compared to the United States. We're in a different phase of the cycle.
But do you think it would be desirable to point out to the markets that even if once we get to inflation targets, that actually running even beyond that a little bit will be something that the bank would tolerate?
No, we haven't discussed this thing at all.
That was Bank of Greece Governor Yanis Strounaris in an exclusive interview. More markets ahead. This is Bloomberg.
Live from London and New York, I'm Naira Chahich with Vonnie Quinn. This is the European close on Bloomberg Markets. Now it's time now for Options Insight with Abigail Doolittle. Abigail?
Thanks so much, Naira. Well, joining me today for Options Insight from the CBOE is Scott Bauer of Trading Advantage. Thanks so much for joining us, Scott, on this day after Thanksgiving. Hope you had a great Thanksgiving. So, of course, we are looking at...
How about you?
Oh, thank you so much. And of course, we're looking at quiet trading here on this day after Thanksgiving. Volumes down significantly. What are your thoughts? Because we do, even despite the quiet day, have stocks at record highs once again.
Yeah, you know, the volume earlier in the week, you know, to me was kind of the indicator here. And, you know, barring anything really odd coming out of OPEC next week or anything else we see, it looks like this rally is going to continue. Now, that being said, with the VIX trading where it's trading right now, you know, really down near historical lows, to me, there's no reason why people that want to stay fully vested, for those that are fully vested in the market, why they shouldn't buy some protection insurance in the marketplace via either the VIX or SPX options using puts are just about as cheap and inexpensive as it gets right now. So I do think we're going higher. I think we can ride this wave through the end of the year. But the other side of that says take a little off the table by buying this protection because it's too cheap not to.
That's an interesting point on the VIX, Scott. We do have it, as you mentioned, at record lows. And complacency here really seems to be high. After into the election, there were lots of jitters, and now we have the VIX, as you mentioned, record lows, lots of complacency. Yep. What could reverse that? What kind of risk-off event could possibly reverse that?
Sure. I mean, obviously, anything out of the White House or out of the Trump party that he does out of the ordinary, that he says maybe he's going to build the fence, or one of these, odd statements he had made could really rattle things.
So basically,
news out of OPEC could rattle things next week. Yeah, any sort of surprise like that. But barring any of that, we got through the earnings seasons okay. Retail looks to lead us through the rest of the year. Obviously, with the banking sector, we've got the Fed next week, or in a couple weeks here. Everybody's expecting the interest rate rise. I don't think that's going to negatively affect the marketplace whatsoever. We have a big jobs number next Friday. Unless that's an abysmal number, I don't think that's really going to affect us to the downside here. So I really think it's something that has to come out of the Trump campaign, or the Trump side of things, that could really derail us at this point.
Interesting. So it sounds as though you think that there's some smooth sailing ahead for the stocks, at least in the near term. As for your trade, Scott, NVIDIA, this is pretty amazing. This chip maker, this graphic chip maker, the stock is up 185% this year, and I know that you have a trade targeting it. Could you talk us through that?
Absolutely. Earlier this week, there was really heavy call buying going out to regular December expiration, all the way up to the 100 strike. Where NVIDIA is trading right now, the option market is actually pricing in a move of about $5, $6 or so, which puts us right at that 100 point going out to December. So what I'm going to do is I'm buying the 96-100 call spread, $4 wide call spread. I can do that for about $1. That's for regular December expiration, so I've got about 3 more weeks on this thing. Based on, obviously, the momentum of this stock, like you said, which has been just unbelievable, the heavy call buying I saw earlier this week, I really like this move up to 100. It seems like that number is going to be a magnet. The downside is my investment of $1 here, so that's my maximum risk. But I think the reward to risk on this type of trade, it's a 3-to-1 reward to risk, given how NVIDIA is traded, given the high call buying we saw earlier this week. I think it's a great trade.
Great stuff. Thank you, Scott Bauer of Trading Advantage, for joining us today. Neighbor, back to you.
And thank you, Abigail. Nice one. Interesting what Scott was saying there about S&P put options and VIX options just being too cheap not to buy at the moment with these markets at record highs. Now, coming up in Battle of the Charts, it's oil and OPEC versus global bonds. I take on Emma Chandra. That's next. This is Bloomberg.
It's time now for our global battle of the charts, where we take a look at some of the most telling charts of the day and what they mean for investors. You can always access these charts on the Bloomberg by running the function featured at the bottom of your screen. Kicking things off today, a special Black Friday treat. Emma Chandra is doing Battle of the Charts for the first time.
I'm actually looking ahead to the OPEC meeting next week, but specifically looking at non-OPEC member Russia. Russia is under pressure to join with OPEC and to agree to a cut, and that's because OPEC knows that it needs significant cooperation with non-OPEC members in order to have any significant impact on prices. So if you look at this chart, you can find it on the Bloomberg as G#BTV4534, and I've plotted Russian oil production, that's the white line, and I plotted crude prices, that's the blue line. And what this chart clearly shows is that Russia has been increasing production in the last few months. So even if they do agree to cooperate with OPEC and they reach a deal and they cut or more likely freeze next week, the impact of that deal is probably going to be muted.
Masterful presentation, Emma Chandra. We will definitely have you back. Nero, what have you got for us?
Well, Vonnie, I'm showing this chart for the second time because I'm really loving it today. We've been talking about treasuries and, of course, the global bond rout. And the question is whether treasuries headed for their steepest monthly loss in 7 years, whether that sell-off has been overdone. I'm looking at the Bloomberg Barclays US Treasury Index here, and I'm looking at the relative strength index because, according to this measure, that sell-off has perhaps gone too far. So basically, this is showing that it's the most overdone since the gauge started in 1973. This 14-day relative strength index reaching an unprecedented 17.48 this month. Anything below 30, as you know, signals that a rebound is due, and that the last time this index was near current levels was in June 2007. Guess what happened last time? The move kicked off a 9-month rally, and you can see my chart on the Bloomberg at G#BTV5140.
I am absolutely certain that both of those charts are going to get plenty of visits just based on both of your guys' presentations alone. And Nero, while I really love your chart, I'm actually going to award the crown today to Emma Chandra.
Thank you very much. Must be beginner's luck.
Oh, see, she's humble as well. Look at that. No, it was perfect. We were just talking about the OPEC, non-OPEC meeting and whether Saudi Arabia will join or not. So there we go, Nera.
Absolutely, Vonnie. Let's take a look where European markets ended the day at the end of the European close. The Stock 600 at a 1-month high, ending up 0.2%. FTSE 100 pushing higher as well. DAX unchanged, CAC 40 higher. If we take a look at the bond markets and the FX markets to see what's happened there, it has, of course, been a weaker dollar day. Euro 105.98. That's it for the European close. This is Bloomberg.
It's noon in New York, 5 p.m. in London and 1 a.m. in Hong Kong. I'm Vonnie Quinn. Welcome to Bloomberg Markets. World headquarters in New York. We're covering stories today from New York to Paris and Vienna to Tokyo this hour. Here's what we're watching. Black Friday is here, and by most accounts, this holiday season should be a boon for retailers after 3 years of shrinking spending. Plus, OPEC's final push for a deal focusing on Iran and non-member Russia. We look ahead to next Wednesday's meeting. And Jaguar is bringing back the original supercar. Bloomberg was given exclusive access to the team in the United Kingdom. We'll bring you inside that operation. Well, we are close to the end of today's holiday-shortened trading session. Abigail Doolittle joins us now with all of the holiday-shortened moves.
Well, the holiday-shortened moves are in the green, Vonnie. We have nice gains for the U.S. averages halfway or more than halfway through the session at this point. In fact, gains that have taken the Dow, S&P 500, and NASDAQ all to record highs, on pace for another set of record highs for the Dow and the S&P 500, potentially the fourth in a row. So some real gains for stocks. It's also worth mentioning that the three major averages are on pace for weekly gains as well, the third week of gains in a row. So again, just big strength for U.S. stocks. As for one market that's moving in the opposite direction, in a pretty volatile direction, we're looking at oil. Oil is down nearly 3.5%. And what could be going on here for the second day of declines in a row is the fact that OPEC is negotiating to work out the supply cut deal that they've been trying to work out for quite some time. They're now negotiating with Iran and non-OPEC member Russia on the supply cut deal after Iraq has signaled that they will cut supply. So this is dragging right now on oil. And the oil drag, the downward action that we're seeing in oil, not surprisingly, is dragging on the S&P 500. The worst sector in the S&P 500 today is energy, down nearly 1%. And we have some of the big E&P players all down significantly, including Marathon Oil, Devon Energy, and Anadarko. As for oil itself, what could be ahead or what's happening, we go into the Bloomberg and we take a look at BTV 5087. This is a roughly 3-year chart of oil. We see that downward plunge when oil had crashed before. We also see in yellow the 200-day moving average, an indication of buying, selling momentum. And when oil is above, that's generally positive. We have oil back above its 200-day moving average. Once again, perhaps suggesting that for the medium to long term, oil is in better shape, but that there could be some near-term volatility, as we are seeing certainly for oil today, Vonnie.
All right, I think that might be a story again next week. Abigail, thank you for that. Now let's check in on the Bloomberg First Word News this afternoon. Taylor Riggs has more from our newsroom.
Vonnie, Katie McFarlane has accepted a job as President-elect Donald Trump's Deputy National Security Advisor. That's according to two people familiar with the matter. McFarlane has a long record of national security experience. She'll work with retired Lieutenant General Michael Flynn, who Mr. Trump named as his National Security Advisor last week. And on Monday, the President-elect plans to meet with 8 people, including former SEC member Paul Atkins and John Allison, a possible nominee for Treasury Secretary. A prosecutor in Paris says 5 men arrested on Sunday were planning a terrorist attack in France as early as next week. He said the suspects were getting their orders from an Islamic State member based in either Iraq or Syria. The 5 men were arrested in Strasbourg and Marseille. And a judge has found the suspect in the deadly Charleston, South Carolina church shooting competent to stand trial. Jury selection in the trial of Dylan Roof starts Monday. Roof is accused of killing 9 churchgoers after a Bible study class last year. And actress Florence Henderson has died. She played the mom in the iconic 70s sitcom The Brady Bunch. It was a comedy about a widow with 3 daughters who marries a widower with 3 sons. The Brady Bunch show led to TV movies, reunion specials, and 2 feature films. Florence Henderson was 82. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Vonnie.
Taylor, thanks. Well, as Abigail Doolittle earlier mentioned, stocks are extending their records on light trading volume. Our next guest says we could easily go from the Trump bump to a Santa Claus rally. Joining us now is Brian Jacobson, Chief Portfolio Strategist at Wells Fargo Funds. Brian, you think stocks are going to continue to go higher. What would be a potential headwind to that outlook?
I think a potential headwind, and we have a few of them on the horizon here. One could obviously be an adverse reaction as a result of the Italian referendum on December 4th. That, I think, is a risk that's not currently really priced into U.S. markets, and if it does get priced in eventually, if it goes as a no, we can maybe see a short-term sell-off. I don't see it as anything that would derail the rally that we're seeing here. The bigger risk, I think, is with the Federal Reserve. When they meet on the middle of December, if they suddenly signal that they're going to increase the pace of rate hikes from, say, 2, which is the current projections for 2017, to something like 3 or 4, that would likely significantly strengthen the dollar, and it could also have an adverse effect on rates and then also interest rate sensitive parts of the market. So I think that some of the Italian politics and the Federal Reserve would be two of the bigger headwinds that I'd be looking at right now.
All right, and then assuming that we do continue this rally, what's the basis for this rally?
I think that a lot of it is just returning to the fundamentals. We've been basically trading sideways since the beginning of August. A lot of it was people being in wait-and-see mode as to what was happening to U.S. elections and also with the earnings outlook. Well, we know that the earnings results came in better than a lot of people were expecting. We're continuing this slow incremental march higher with earnings per share. And the presidential election, markets kind of took it in stride, and maybe it gave people a little bit of a second wind anticipating tax cuts and a little bit of regulatory relief that could propel earnings for 2017. Clearly, there is a risk that if President-elect Trump decides to start talking more about trade tariffs and building walls instead of building bridges, that could be a headwind to the market. So it definitely merits watching every single tweet and word that comes from the president-elect.
But with the S&P 500 up 8% this year, year to date, and the Dow up as well, I mean, you say we're returning to fundamentals, but are we returning to company-specific fundamentals in the sense that companies are fine, they're going to be beating, for real fundamental reasons in the next several quarters, or is this something a little different?
I think that it's also, a lot of it is due to sentiment. We've seen that in the University of Michigan's Consumer Expectations Survey, where they talked about how it is that the people surveyed after the election were a little bit more optimistic and upbeat than those who were interviewed before it. And I think the same thing applies to investors. So it's not just purely fundamentals. It never really is. It's also about the sentiment, the way people perceive the future. And I think that really what we're going to see going forward, we've seen a big repricing of a lot of sectors. And now, going forward, I'm thinking that it makes a little bit more sense to look at the details, the individual names within individual sectors and industries for the opportunities. So you get this big reflation or repricing of certain sectors, but not everybody's going to win and not everybody's going to lose. And now you have to sort of do the sifting and winnowing.
Brian, I'm just curious, is it an overstatement to say that when this market turns, be it equities, treasuries, and other assets too, it really turns quite substantially and you see a major reversal? What's the risk of something like that happening between now and, say, Inauguration Day?
Sure. I think that there's a material risk of there being a pullback depending upon, what's going to be the catalyst for it. Will it be because the OPEC negotiations fall apart? Will it be because of Italian politics? Will it be because of a slightly more hawkish Fed? So there's any number of things that could be the catalyst to it. I would view those as short-term buying opportunities. But when I look at sort of the patterns that the market's tracing out, it's actually somewhat similar to what we saw in 1952 with the election of Eisenhower. You also had a weak majority of Republicans taking the Senate and the House in that election. You had a very nice about 8% run-up from Election Day to around the early part of January, and then there was a correction. So, basically it spent a lot of 2017 recovering from an early correction. That was triggered by political issues. You had the hydrogen bomb being tested. You had Stalin dying in the Soviet Union. So there are all sorts of a number of things that triggered it. So there are a certain number of catalysts that could trigger it. But I would say just, fasten your seatbelt and strap yourself in.
Well, Brian, would you be an unequivocal buyer of U.S. stocks that have international exposure, the large and mega caps, with a stronger dollar that seems to be continuing to strengthen, and a little bit of a murky outlook for the deficit?
Yes, the deficit doesn't bother me all that much as far as how it might affect the market. There just really is no empirical relationship that you can definitively point to between rising deficits and how the stock market performs, or even how inflation performs. The stronger dollar, I think, could be a headwind to larger cap multinational companies, and that's why we've been biasing towards smaller and mid cap companies. It's also why we've been biasing away from emerging markets. However, I think that the opportunity will present itself when the stronger dollar will turn to a weaker dollar story. A lot of the strength of the dollar is probably due to fears of U.S. growth not bleeding over into non-U.S. growth. The way in which we share U.S. prosperity is through the trade deficit, and also through a slightly stronger dollar that should help support growth in other countries. So I think that we could actually, between now and Inauguration Day, have a pretty good entry opportunity back into U.S. large caps, and more importantly, I think, into emerging markets.
Brian, very quickly, is the sell-off done in treasuries now?
I don't think that it's completely done. If you look at how things traced out during the taper tantrum, we got up to 3% on the 10-year. I think we could probably get to 2.5%, maybe 2.6%. So maybe it's not completely done, but I think that it is a little bit overdone, and the worst is likely behind us.
All right, Brian Jacobson, we have to leave it there, Chief Portfolio Strategist at Wells Fargo Funds. Thanks for joining. Coming up, has Black Friday lost its luster? We dig into the numbers behind the nation's most famous shopping holiday next. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. It's time now for the latest Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. European Union regulators are in settlement talks with banks suspected of rigging currency markets. That's according to people familiar with the case. It's part of an investigation that's already led to multi-billion-dollar fines in the US and the UK. Barclays and HSBC have previously said their currency trading was being reviewed by the EU. Lufthansa has put out a new offer on the table in an attempt to end that three-day strike by pilots. The German airline is offering the pilots a raise tied to reform of the company's pension system. The strike has forced Lufthansa to cancel more than 2,600 flights, and it's expected to continue through tomorrow. And President-elect Donald Trump's campaign is offering Black Friday discounts at its online merchandise store. The site is offering discounts of 30% in honour of the day. Hillary Clinton's merchandise store is still operating, but is taking a much more low-key approach. And that is your Bloomberg Business Flash update. Well, the year-end shopping rush is in full swing, and of course today, as we said, is Black Friday, traditionally one of the busiest shopping days of the year. But as online shopping grows, Black Friday might be losing some of its luster, as people can often find bigger bargains online instead of heading to the stores at 5 a.m. in the morning. With more, let's bring in Bloomberg's Lindsay Rupp, who covers retail and also hosts the podcast Material World. Lindsay, welcome. Well, I just want to quote from a Bloomberg Gadfly piece that we have saying that as of early this morning, queues outside of stores and scuffles inside were conspicuously absent, in stark contrast with just 2 years ago when fights broke out as consumers sought to snag cut-price TVs. This is Andrea Felstead on Bloomberg View. So it does seem that consumers are really embracing the shift to mobile.
Yes. I mean, part of it is that stores are open on Thursday night now, so if you really want to get those doorbuster deals, you're probably coming out after you've finished your turkey on Thursday. But it is also online. I mean, we're seeing those numbers come in really strong for Thursday and also for today so far. People are shopping on their phones. You know, you've got a bigger screen on your phone. It's a little easier to browse. You can do it while you're in the car waiting for, I don't know, waiting for dinner. I mean, you can shop anywhere at any time, and that's really reducing the need to actually go out, get in your car, go to a store.
Plus, every time you check your email, it's so difficult not to click on the link, right? When it, you know, what are the methods that retailers are using, though, to lure you in? Because I'm seeing a lot of, 20% discounts, 30% discounts. Fine, but I'm not really going to spend unless I was planning to buy something anyway.
Not enough for you, yeah. Well, we are seeing that discounts this year are, in fact, deeper than they were last year. So price is a big lever that people are pulling. We're seeing a lot of targeted discounts. So Victoria's Secret last night did a half off all bras campaign. We're also seeing a lot of free gifts, like free gift with purchase or free gift for walking into the store. A lot of department stores this year are relying on some of those cash giveaways. So you've got JCPenney offering Thursday a $500 off a $500 or more purchase to people who came to the store early. I think Old Navy is doing a similar promotion. For 8 days, they gave away $100,000 to a surprise customer.
So all anecdotal reports I've seen, and some reports from Adobe and from other places as well, are that consumers stopped spending around the election, and that certain segments of the community, at least, are back and running. Perhaps not everybody. It seems that immigrants, according to reports, are not spending as much because they're tightening their belts just in case. The future is unforeseeable, but the consumer is out there and is confident.
Right. So the hopes are that now that the election is behind us, we're going to be focused on holiday spending. The consumer's in a really good place. Wages are starting to go up, and unemployment is down. Gas prices are down. They have money in their pocket. They should be spending. So retailers are really hoping we're going to see them come out strong. The National Retail Federation is expecting holiday sales to increase by 3.6%.
Is that more than the NRF typically expects to see?
It's pretty much on pace for what they've seen the last couple of years. I mean, it's not a gangbuster number for sure, but it would be good growth. And at this point, retailers, with all the competition, could really use some solid growth.
And we're seeing bankruptcies, right? We're seeing bankruptcies, and we're also hearing reports of certain retailers not paying their bills. Perhaps they're being late with their supplier invoices and so forth. Is it a case of certain retailers are just getting it right and they'll be fine and they'll see nice, generous growth? Other retailers are not only not going to see growth, but they're not getting it right and they're just going to be gone this time next year.
Yeah, I mean, it's really difficult to kill a brand. I think we've seen that over the years. But for a lot of people, Christmas is a big time. And if you don't have a solid holiday and you're already kind of circling the drain, it could, we see a lot of retail bankruptcies in January. It could really push some people over the edge. But yeah, if you're not innovating and you're not making making your store a fun experience and you're not, reducing your footprint, using it effectively, making your online website and your mobile app something that's like a pleasant experience for customers to use, you might really be in trouble.
Is Black Friday a thing for the luxury segment at all?
I think everybody likes a deal. We've seen that across all income levels. The quality of the deal you'll get might be a little bit different. But, it is a global phenomenon. We're seeing it in the UK, and we're seeing it even in Brazil. So I think everybody kind of wants to get in the game. Everyone wants to feel like they've got a great value.
So it's early, and we still have Cyber Monday to get through.
Yes.
If people aren't sick of typing in their passwords by then. But who looks to be maybe a winner or two?
Amazon's looking really good, of course. Target's looking pretty good. Walmart is looking good. Those value chains, those discount players. Electronics is seeming strong. Toys are seeming strong, and we're seeing actually some pickup in apparel. So that would be something different.
That's exactly what Brian Cornell was saying this morning. But I believe you both. We'll see. We'll wait till the data comes in. Lindsay Rupp, Bloomberg News. Thank you, and thanks for not being outside at a mall, so you can join us in studio.
Happy to be here.
Still ahead, OPEC is scrambling to work out its squabbles ahead of next week's big meeting in Vienna. What will happen to oil if a deal does not get done? This is Bloomberg. Bloomberg Markets, I'm Vonnie Quinn. Well, the journey to an OPEC deal is hitting another speed bump. Saudi Arabia has pulled out of talks with Russia and other non-OPEC nations about how to share the burden of a supply cut. That's the sticking point. On top of that, there is still disagreement within the cartel, with both Iran and Iraq not 100% sold on cutting production. Joining us now is Bloomberg's managing editor for energy and commodities in the Americas, Tina Davis. What a mess, first of all, but also we knew this was going to be the case. What would Saudi Arabia deciding that it's not going to talk to non-OPEC and OPEC before it talks to OPEC, has that any implication for a final deal?
Well, it's been a little bit of a game of whack-a-mole as we run up to this meeting, which is a very crucial meeting. 2 months ago, they agreed in theory to a cut, and now the details of who's actually going to do what have really been causing a lot of, as you called it, speed bumps in the process. So Saudi Arabia making this decision now that they're not going to take part in this extraordinary breakfast meeting that was planned for Monday, really puts more pressure on within OPEC for them to figure out the details of what they're going to do long before they actually have the ministers in on Wednesday.
It's fascinating because Saudi Arabia is really the voice of OPEC in a lot of ways. So, you know, I mean, it's not just any country is not taking part, it's the country is not taking part.
Right. For a long time, what Saudi Arabia has said has been what OPEC's feelings were on the topic. In the interim, as they've been trying to cut production, it's really been focused more on what Iran and Iraq have been doing, or rather not doing, as they try to sort of reach some sort of consensus. So in a lot of ways, the upstarts have become much louder voices and much more crucial voices in the discussions now.
So what happens to prices if there's no deal?
Well, I mean, you could have two scenarios. If there is a deal, there's discussion that prices could hit $60. If there isn't a deal, we might go below $40. There could be a scenario where you sort of win by losing. If there is no deal, you see the price drop, but that continues to drive some of the competitors out of the market, which could ultimately be good for OPEC in the long run.
How are particularly U.S. shale producers sort of looking at all of this? What do they want? What would be the ideal outcome for those producers that have been on the line about switching back on some rigs?
Well, the ideal outcome is for OPEC to cut production, slash production, so that you can see, again, prices in the triple digits. Now, that's not likely. What they would like, and what a lot of them has publicly said, is that $60 oil really draws everyone back out. Everyone's dusting off their rigs, everyone's getting back out, looking for more oil and gas again. And $60 oil would definitely make that possible for a lot of shale producers.
And I'm sure there are many, many towns across the Midwest that would just be desperately happy if that were to be the case as well, economically speaking.
Yeah, I mean, I think the Bakken Shale, you would see much more activity there. You would see perhaps more activity offshore. A lot of that has been curtailed since that's some of the most expensive oil there is. There's a lot of places where people would be ready to dive back in.
Briefly, the OPEC and non-OPEC ministers do start to gather over the weekend in Vienna, so we should start sort of hearing rumours and speculation and, aids to XYZ talking from tomorrow. Anything we should look out for?
I think one crucial thing tomorrow is going to be the energy minister of Algeria meeting in Tehran with the Iranian minister to see what can be done there. Obviously, it's more of a bilateral meeting, but the Algerian minister has been quite fundamental in some of these discussions and trying to get a production cut agreement. And whatever Iran does might help sort of bring the rest of them on board.
Well, it was originally brokered in Algiers, or at least it looked like it was going to be brokered. Whether it has been or not, I'm sure the Algerian oil minister would love for it to be known as the Algiers Agreement, right?
Right.
All right, Bloomberg's Tina Davis will be all over it for us throughout the week. And thanks for that. Coming up, we'll be back to Black Friday sales. This is Bloomberg. Thank you. Beautiful, but a little cloudy there in San Francisco. Looking up the streets of San Francisco up to the hill there. Beautiful shot. All right, let's start with the headlines on the Bloomberg First Word News this afternoon. We're going to our newsroom and Taylor Riggs.
Bonnie, the Prime Minister of Hungary says he'll no longer be considered a black sheep in the eyes of Washington. Viktor Orban says President-elect Donald Trump has invited him to visit. In July, Orban became the first leader in Europe to publicly back Trump. President Obama shunned Orban during his 2 terms and criticized him for eroding democracy. And 2 trains collided in North Iran, killing at least 36 people and injuring nearly 100. Helicopters and ambulances rushed the injured to hospitals. The accident occurred in sub-zero temperatures when a passenger train hit another that stopped at a train station about 150 miles east of Tehran. And more than 70 people were killed in a car bombing at a gas station in Iraq. About 65 people were also injured in the attack. Islamic State militants are claiming responsibility for the deadliest attack since July, when a car bomb killed 300 people in Baghdad. And a new report underscores just how far Japan is from achieving its 2% inflation target. Consumer prices there fell in October for the 8th straight month. Excluding fresh food, the Japanese CPI dropped 0.4%. The government may increase fiscal spending next year to help rising prices. And it's the final White House Christmas tree of the Obama administration. Michelle Obama was there as the tree was delivered. It's a 19-foot-tall Douglas fir from Pennsylvania. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Bonnie?
Taylor, thanks. Let's get a quick check now on U.S. stocks. We'd have a look at the majors, and we can see that the Dow is at 19,132, holding on to those highs, up 49 points, 0.25%. The S&P 500, 0.25% higher, too, with just about 30 minutes left in trading, and the Nasdaq up 0.2%. Well, for details now, and to see what the volume is like, let's go to Bloomberg's Abigail Doolittle.
Hi there, Vonnie. Well, the volume is down today, which is pretty typical to this day after Thanksgiving, as are the retail stocks. Not that that's necessarily typical, but we do have the retail stocks trading lower on Black Friday. The one exception it's flipping right around even. Amazon, I was about to say, is the one exception, but it is flipping between small gains and losses, as the other retailers, Macy's, Kohl's, and JCPenney's, are all down more than 1%. So it appears that the e-commerce giant Amazon is besting the bricks and mortar stocks. In fact, this may reflect what Telsey Advisory Group was talking about earlier, saying that traffic is lower at some of the bricks and mortar store, perhaps helping to explain why some of those stocks are down. You would think that this would bode well for Amazon, especially the fact that Amazon has said that this Thanksgiving their online sales were at a record $2 billion, especially for the stock going forward. But when we did some looking back at some of the data in terms of the stock performance of Amazon in the month of December, not so much. Amazon is actually down more than the S&P 500 and retail ETFs in the month of December. Amazon is in blue, and you can see that tremendous underperformance. To dig into what could be behind this, Jitendra Worrell and Paul Sweeney, both Bloomberg intelligence analysts, said that they thought this could perhaps be sell the news and also lack of catalysts. As for November, when we go into the Bloomberg and we take a look at #BTV 5147, this is data based off of First Data Merchant Services, and over to the side there is November. In blue, we have transaction growth. In white, we have, ticket growth is in blue, and we see that both are down for the month of November, suggesting that perhaps this is going to be a difficult month. It's unclear whether this Black Friday weekend, Vonnie, can turn these numbers higher. But when we take a quick look at the luxury retailers, there does not appear to be too much of a boost there. We have all three, Tiffany, Kate Spade, and Ralph Lauren, all trading lower on this Black Friday. So not a lot of good news right now for retail stocks on Black Friday, Vonnie.
No, I guess there's always Cyber Monday to come as well, and they can hold out some hopes for that day as well. Thanks, Abigail Doolittle. Well, it is Black Friday, and this holiday shopping season could be a boon for retailers. We won't know for a while after 3 years of shrinking spending. About 137 million consumers will shop in stores or online over the 4-day weekend that started yesterday, according to the National Retail Federation. I spoke to Target Chairman and CEO Brian Cornell earlier this morning after he rang the opening bell in celebration of the retail extravaganza.
Well, we saw a very strong margin improvement in our third quarter. We saw an 80 basis point improvement in gross margin rate during the quarter, and that's driven by really strong mix management. So as we continue to grow categories like apparel, where we've seen 7 straight quarters now of market share gains, growth in our home category. Last year was our best year in a decade, up over 4%. When we win with kids and baby, with apparel and home, that works out really well from a margin standpoint. And from a shipping standpoint, we've gone from a couple of years ago having just over 100 stores where we used our stores as shipping centers. This year we've got over 1,000. So we've got stores conveniently located in neighborhoods, and working with UPS or FedEx can efficiently and conveniently deliver that last mile. So we think we're very well positioned to meet the consumer needs throughout this holiday season.
Well, interestingly, at a time when many retailers and department stores are closing brick and mortar branches, you're actually opening them in
Yes,
urban areas as well. What's behind that strategy? Why do you believe that's the correct strategy?
Well, we're following the U.S. consumer, that more and more is moving into urban centers. They're moving back to New York City, they're in Philadelphia and Boston, moving to downtown Chicago, even our hometown of Minneapolis. So we're following the consumer, we're following our guests, and opening up these neighborhood stores. They are much smaller. We customize them for the local neighborhood needs, so every store custom tailored. And we're seeing a sensational response. Our store here in Tribeca, perhaps our most successful new opening. It's about 38,000 square feet. It's a neighborhood store, and we've really connected with the local guests. So we think this is a terrific new growth vehicle for us, both in urban centers and also on college campuses where we're opening up across the country. So we think we have the opportunity to open up hundreds of new urban, smaller stores to complement our existing footprint.
You know, Brian, Amazon is the behemoth, and everything you do has to be, to a certain extent, to compete with Amazon as opposed to other retailers. What other investments and how much, technology-wise, are you making in order to beat Amazon?
Yeah. Well, over the last couple of years, we've been investing billions of dollars in both technology and supply chain. We're also investing in improving our in-store experience. So we think we win as a company when we provide our guests a great in-store shopping experience, when we provide the convenience of ordering online and then picking up in one of our 1,800 stores, and then also the ability to quickly ship to their home. So we think that gives us a huge competitive advantage. Having great stores to shop, having stores where you can order and pick up at your convenience, and also the assurance that we can get that package to your home in a very short period of time.
What about beacon technology or in-store technology to, decipher customers' tastes and perhaps follow them around as other shops do?
Well, we're testing a number of different new tools and capabilities, and it's all about making sure we deliver what the guest is looking for from Target. So we'll continue to test new technology, make sure we make it really easy for the guest to shop. But when they shop, we want to make sure it's inspiring, we offer great value, we're a welcoming environment. When we put those pieces together, people enjoy shopping our brand.
Brian, what categories could be better, could have a better mix? And I'm talking about from the suppliers, because we've been hearing about struggles in apparel, that's one thing. But, anecdotally, I'm also hearing that really there's not a lot of new in electronics. What are you appealing to suppliers to build and make and innovate for you?
Well, we're always looking for unique products. So as we enter the holiday season in a category like toys, working with Mattel, working with Hasbro, our great partners at Disney, we've got 1,800 unique proprietary items within our store. So we want to make sure we provide great newness, the brands our guest is looking for, but we've also been focusing on building our own brand portfolio. And in apparel, we offered a great new kids apparel line called Cat and Jack. We expect that to be a $1 billion brand in the next year. So the combination of newness from our vendor partners, the brands we're developing ourselves, and creating a great in-store and online experience, we think that's critically important to our future success.
Give me a few hard numbers, if you would, Brian. What's your forecast for margins for the year?
Well, we think the kind of results we delivered in the third quarter, where we continue to grow our market share in apparel and home, in baby and kids, that allows us to continue to provide great value, but also manage our margins very effectively. So I feel the team is doing a great job of managing gross margin rate as we go forward.
Do you anticipate it north of 27%?
Well, in the third quarter, our margin rate was closer to 30%. So very strong margin flow through. And again, it's a combination of great rates, the mix that we're seeing from those core signature categories like apparel and home, beauty and kids, and making sure we're managing our cost of goods very carefully. So I felt very good about the results.
You mentioned the other night on a call with reporters, in fact it was last night I believe, that yes, you'd love to see 3% GDP growth in the US, but it is a good time for the consumer because of lower gas prices and lower food prices as well. Do you anticipate 3% GDP growth in the next 4 years under the Trump administration? When are you anticipating that?
Yeah. Well, I'm very optimistic about the consumer economy. I think it's a great time to be a consumer in the U.S. As we talked about, the overall GDP growth is solid, and I think it's going to continue to expand. We're seeing good movement in employment, low interest rates, low inflation, and certainly in food, deflation. So for the U.S. consumer, I think this is a great time. And when it's a good time for the consumer, it's a great time to be a retailer.
And that was Target Chairman and CEO Brian Cornell. We do have some breaking news already from Vienna. A delegate telling Bloomberg that Monday's OPEC, non-OPEC meeting that was due to take place at least is now cancelled. The gathering will now only be attended by OPEC officials, according to the delegate, who didn't want to be identified because the information is private. Now, this is on the heels of Saudi Arabia pulling out of that, informal OPEC, non-OPEC meeting, which had been planned. It was to include Russia because disagreements about how to share supply cuts were those disagreements were hampering progress for the actual OPEC meeting, which is to take place on Wednesday. But anyway, it looks like that's cancelled now, the OPEC, non-OPEC meeting Monday. But we will hear more rumours, that's for sure, over the weekend. Coming up, the original supercar. We'll take a look at Jaguar's recreation of the classic 1957 XKSS next. This is Bloomberg. I'm Vonnie Quinn.
And I'm Naira Chehich. This is your Global Business Report. The UK economy looks to be resilient in the wake of the Brexit vote. GDP rose in the latest quarter.
Amazon looks to be gaining a foothold in the Middle East. The retailer is in talks to acquire Dubai-based online retailer Souk.com.
Is Black Friday still the holiday shopping frenzy it once was? In today's Quick Take, we look at how contemporary trends may be dulling the appeal for consumers.
The chairman of Sweden's Nordea Bank says there's little chance he'll resume merger talks with ABN AMRO. And he signalled the Dutch government has shown no interest in buying shares in the bank. He spoke exclusively to Bloomberg.
This was an exceptional opportunity to just ask the question whether the Dutch government that has committed itself to a sell down in ABN AMRO would consider an alternative route, which would offer them better liquidity, but which would also transform the landscape. It turned out they, at least for now, were not interested, and that's it really.
Meanwhile, Johnson & Johnson has approached Swiss drug maker Actelion about a possible takeover. That's according to people familiar with the matter. Actelion has a market value of about $17 billion. The company has brought to market 2 new lung medicines that are poised to become blockbusters.
The British economy showed no third quarter after effects from the Brexit vote. Consumers and businesses both increased their spending. GDP rose 0.5%. Still, the Office for Budget Responsibility has slashed its forecast for growth next year to 1.4%. The falling pound is expected to squeeze consumers by pushing up the cost of imports. It's official. London homes are less affordable than ever. It now costs the average Londoner 14 times their annual salary to buy a home. That's more than double the ratio for the UK as a whole. All this from research firm HomeTrack. Housing prices in London have risen 86% since 2009. The supply of new homes has failed to meet demand from Britons and overseas investors. Amazon is looking to get a foothold in the high-growth Middle East market. People familiar with the matter tell Bloomberg Amazon is in talks to acquire Dubai-based online retailer Souq.com. The price? About $1 billion. Souq.com had originally planned to sell a stake of at least 30%. Neither company is commenting. The debut of Airbus's biggest A350 signals the triumph of twin-engine jets. The plane made its first flight yesterday. It carries 366 people. That's just 44 fewer than Boeing's 4-engine 747. Both the 747 and Airbus's 4-engine A380 are struggling to find buyers. The twin-engine planes are much more fuel efficient.
Time now for our Bloomberg Quick Take, where we provide context and background on issues of interest. For most of the last decade, Black Friday has been America's biggest shopping day. Now, contemporary shopping trends are dulling the day's appeal for consumers. Here's the situation. Last year, over the 4-day weekend of Thanksgiving through Sunday, 103 million people made purchases online, compared with 102 million who visited retail stores. It was the first time online shoppers outnumbered in-store shoppers. The weekend still accounts for 10 to 15% of holiday sales, but it's an increasingly harder sell. Recent sales in the US over the 2015 Thanksgiving weekend fell to 10% to $20.4 billion. Here's the background. Nobody is sure exactly how Black Friday got its name. An urban myth claims the name marks the first day of profitability for retailers each year when they get into the black. Don't believe it, though. November and December account for about 20% of retailers' annual sales. So in most years, companies are profitable well before the fourth Friday of November. In 2005, retailers coined the term Cyber Monday to discuss a surge in web purchases on the first workday after Thanksgiving. Now, an increasing number of online shoppers, particularly those buying on their phones, are skipping the stores entirely. Other countries have traditions similar to Black Friday. Many retailers in British Commonwealth nations open early for Boxing Day, right after Christmas, for example, with deep discounts for customers waiting online. Still, it's been difficult for retailers to export Black Friday overseas. Here's the argument. Retailers say the crowds that still show up on Thanksgiving night prove they're giving customers what they want, despite complaints that they're ruining Thanksgiving. Customers, though, have more choice than ever over when and how to shop now. The days of long lines, customer stampedes and overrun malls that characterized Black Friday's time could be waning. You can read more about Black Friday and all of our quick takes at NI Quick on the Bloomberg, and that is your global business report. Head to Bloomberg.com for more stories. It's Bloomberg Markets. I'm Vonnie Quinn. Jaguar is bringing back the original supercar. The luxury car maker is recreating the XKSS using the techniques and materials of the original, built in 1957. Well, Bloomberg was given exclusive access to the team in the UK working on bringing back the legendary automobile.
The XKSS is one of the most special supercars out there. With only 16 of them being made, they're very, very rarely seen. If we take the XKSS and we look back, in 1954, the D-Type hit the track, so to speak, and it made a big impact at Le Mans. It would do close on 180 miles an hour, it would do a 0 to 60 in around 4 seconds. And that's phenomenal. Even many cars today won't touch those sorts of figures.
In the race, we get up to about 175 to 185 miles per hour.
There was a strong pull from America to produce a sports car based around the D-Type, the Jaguar XK SS's. On the 12th of February 1957, there was a fire in the factory.
2 weeks after the £3 million fire.
And there were a number of D-Type stroke XKSS's in that fire, to the tune of 9 of them. The project really has been all about replacing those 9 vehicles. It was the original supercar. My name's Kev Riches. I started as a Jaguar apprentice way back in 1974. For me, it's almost about recreating a piece of art, because these vehicles are art these days. For me, being a real petrol head, effectively, I think for me it was all about building an authentic car and trying to make the car as accurate as possible to the cars that were built in the period. What we're doing on this car is going back to 1955, effectively, and beyond that, to hand form all these panels. So all these surfaces, they're all hand formed and they're rolled using the English wheel. Hand rolling steel or aluminium is a very, very specialist skill. I prefer to call it an art. It's not. You're less of an engineer and more of an artist. So for me, it was about trying to build that perfect car to the period specification in the period way as much as possible. But also trying to look to see how today's technology could help us as well. We scanned 4 cars, and when you looked at each of those cars, they were slightly different. The CAD team have taken that data, and they've created, in a virtual environment, what this car actually looks like. And that's enabled us then to actually look at this in a virtual environment and understand exactly what it is we're going to build. I want to be able to look around it and see everything as it was. I mean, the research we're doing on the fixings, the nuts, the bolts, the oddies, we're even having to reproduce some of the nuts ourselves because you can no longer buy them. As soon as we announced we were going to build these cars, I think they were sold over that weekend. So to sell 9 cars that quickly was quite an achievement. Put it this way, if I remortgaged my house, I couldn't afford one. They're certainly over £1 million apiece. That's £1 million, not dollars.
And that was an exclusive look at the resurrected Jaguar XKSS. For more, check out Pursuits, your destination for the finest things in life, including travel, watches, dining and property and cars. Just head to NI Pursuits Go on the Bloomberg. The market close is next. I want to take a quick look at the major averages. Less than 5 minutes to the close, with the Dow up about 0.3% at 19,137, and the S&P up 1/3% at 2211. We also have the Nasdaq up 0.33%. I also want to draw your attention to the South African currency, which is just about 0.2% stronger now. But the main news is that a few moments ago we got the news that South Africa has moved closer to a junk credit rating. Fitch has changed its outlook to negative from stable and warns that continued political instability could result in a downgrade. This is Bloomberg. In New York, 6 p.m. in London and 2 a.m. in Hong Kong. Good afternoon, I'm Bonnie Quinn. Welcome to Bloomberg Markets. You can barely hear me above the roar of the crowd. It's an extra special Black Friday close. We are moments away from that closing bell. And let's have a look at stocks. As we see, another day in the green and records as well. The Dow is up about 0.33%, 63 points to 19,146. The S&P 500 up almost 0.4%, a little extra push here at 2212, and the Nasdaq up 0.33%. Well, highlights from the last 4 hours or so of action is Abigail Doolittle's bailiwick.
Well, green indeed, Vonnie. We do have the major averages, the Dow, S&P 500, and NASDAQ, all trading higher on the close, closing higher, modestly so, but enough so to put all three averages on record closing highs, intraday highs, so lots of bullish action for U.S. stocks. In fact, for the Dow and the S&P 500, this is the fourth record close in a row and the longest such winning streak since 2014. So again, a bullish Black Friday for stocks. stocks. Now, the big news on the day, however, is coming in the world of healthcare. Actelion, Europe's largest biotech firm, surged to a record high. It closed at a record high, having its biggest day ever on the confirmed news that J&J made an initial takeover offer of $17 billion. This would, of course, expand J&J's pharmaceutical pipeline, and of particular interest are Actelion's lung treatments. So both stocks trading higher, but of course Actelion having that best day ever. As for one area of mixed trading, more in the red, retail here in the U.S., we're looking at Amazon and Walmart closing higher, Tiffany and Kohl's trading lower. Now, all of this happens on multiple reports that traffic here on Black Friday was below what perhaps some were expecting. This includes Telsey Advisory Group, along with Piper Jaffray, while KeyBank is confirming that their reports, their checks in malls over 5 states also suggested that traffic is low, but they believe that both Amazon and Walmart are the big winners. And of course, we do see both of those stocks up. Very interesting to see that confirmation. And finally, oil. This is one of the more volatile markets on the day. Oil down about 3% as OPEC is, of course, still trying to reach supply cut deals, trying to convince Iran to cut supply, also reaching out to non-OPEC member Russia. This, Vani, not surprisingly, is weighing on some of the E&P majors, including Marathon, Devon Energy, and, of course, Anadarko Petroleum, Vani.
All right, Abigail, a long weekend to come before even Monday when it comes to those OPEC and non-OPEC talks. OK, let's check in now on the Bloomberg First Word News this afternoon. Emma Chandra has more from our newsroom.
Thank you, Vonnie. Katie McFarland has accepted a job as President-elect Donald Trump's Deputy National Security Advisor. That's according to 2 people familiar with the matter. McFarland has a long record of national security experience. She'll work with retired Lieutenant General Michael Flynn, who Mr. Trump named as his national security advisor last week. On Monday, the President-elect plans to meet with 8 people, including former SEC member Paul Atkins and John Allison, a possible nominee for Treasury Secretary. A prosecutor in Paris says 5 men arrested on Sunday were planning a terrorist attack in France as early as next week. He said the suspects were getting their orders from an Islamic State member based in Iraq or Syria. The 5 were arrested in Strasbourg and Marseille. A key aide to Brazilian President Michel Temer has stepped down after being dragged into an influence trafficking scandal. The departure of Jadel Vieira Lima, Temer's top congressional liaison, threatens to revive political uncertainty in Latin America's largest economy. Lima and the president were accused of pressuring for the construction of a building in which Lima has a stake. South African President Jacob Zuma will mount a legal challenge to allegations of corruption. This, as a report by the country's ombudsman calls for a judicial inquiry into claims that members of a prominent family who are in business with Zuma's son influenced cabinet appointments and state contracts. The report says Zuma and some ministers may have breached the government's code of ethics. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Vonnie.
Emma, thanks. Well, for years, the dance between central banks and financial markets has been closely scrutinised, forever really. But our next guest says this symbiotic relationship is about to wind down. Joining us now from London is Gabriel Stein, Managing Director of Developed Market Economics at Rubini Global Economics. He recently wrote a note entitled The End of Central Bank Accommodation. Anybody on the face of it, Gabriel, would say that it might be the end, at least the beginning of the end here in the US, but it's not the end in Europe.
No, it's a complicated issue, of course, but basically what it boils down to is since the Great Recession, the global financial crisis, whatever you call it, erupted, markets have become very central bank dependent. Fair enough. One can debate if that's a good thing or not. But central banks have also become very market dependent. They have acted as if they're terrified of letting markets fall, always ready to step in, always feeling the need to explain constantly exactly what they are going to do. And we've seen in the case of the Fed how they spend months preparing markets for a rate hike, then something happens, a rogue non-farm payrolls report, and they withdraw and they have to start the whole process again. And it's very clear they're not happy with this, that they want to move away. They want to be truly data-dependent, fundamentals dependent, not market dependent. But In the case of the Fed, that means they want to raise interest rates, and they will. In the case of central banks elsewhere, it doesn't mean that they will do something. It simply means that they won't be ready to drop everything in order to prop up markets again. And that in itself means less accommodation.
There's always been a bit of a symbiotic or parasitic relationship between markets and at least the Federal Reserve anyway, Gabriel, right? I mean, there was signals sort of being sent both directions quite often. So what really has changed?
What's changed is that central bankers, notably some from the Fed, but elsewhere too, as in the Bank of Canada, are feeling that they've gone too far, that in essence markets have been given a suspensive veto, if you want, on central bank action. They can't block it, but they can delay it, postpone it. And that means that central banks are finding their freedom of action circumscribed. They can't do what they want, what they feel the economy needs to do. And frankly, also, if you look at the United States, growth is decent. It's not torrid, it's not red hot, it's cautious, it's modest, but it's decent. It's headed in the right direction. If under these circumstances the Fed cannot begin to normalize monetary policy, when on earth can it do it? And if markets really desperately need zero rates all the time, what's the point of markets in that case? Then they're artificial.
Gabriel, I want to explain a chart that I'm bringing up on my Bloomberg here. It's 154 in the chart library, but it basically shows what central banks have on their balance sheets as a percentage of GDP. And for the Bank of Japan, it's clearly way up there. It's, you know, I'm not sure if you can see the graphic, but it's a...
I can see.
You know, I mean, compared to the Bank of Japan, say, it doesn't look so bad when it comes to the European Central Bank and the Federal Reserve. Is that a little misleading?
It doesn't look bad because the Bank of Japan is so extreme. But the Federal Reserve, the European Central Bank, the Bank of England, they hold assets equivalent to about a quarter of GDP. That's bad enough because if they will continue to hold these assets when interest rates begin to normalize, that means they have to pay interest on them to the owners, which are the banks and so on. That's really not necessary. More to the point, again, it distorts markets. If the central bank is a massive owner of treasuries or gilts or whatever, that's a clear market distortion. And we're seeing talk of the scarcity of safe assets and so on. And finally, what if there is in the future another downturn and the Fed feels it needs to implement another bout of QE? Do we want to end up in a situation where the Fed, like the Bank of Japan, owns something like three-quarters, has assets equivalent to three-quarters of GDP and owns the overwhelming majority of government debt?
Right, well, so given that we have that as the background, and now we have a new president-elect and a whole new set of policies about to be introduced, what impact do you think easier fiscal policy and tax cuts potentially, a lot of them potentially, will have, you know, on this situation, which clearly is already a little bit worrisome, according to you?
Well, if you look at the US, you already have a situation where most leading indicators are gently trending upwards. If we assume that the new administration really will be able to move ahead with fiscal easing, which by the way, we do think will happen, though the details are not entirely clear, then that will give a further impetus to growth. That in turn, if fiscal policy comes into play in that way, it means the Fed and monetary policy no longer have to be the only game in town. And that, too, particularly since stronger growth will mean higher inflation, and as the president of the St. Louis Fed, Jim Bullard, has already said, the Fed is already in striking distance of its inflation target. It means it gives support to those on the Fed who feel that it's time to move ahead and normalize interest rates. Though I should say the new normal will still mean lower interest rates than in the past.
Well, the 10-year term premium has been climbing up from negative levels, and you know, this is all part of one big movement, which is also dragging yields in Europe up a little bit, particularly in certain countries. What is fair value in terms of a term premium at this point, Gabriel? Is it possible to give me a guess?
I wouldn't even begin to guess. But what I will say is this. expect bond yields to back up further, but also expect at some stage, I don't know where, perhaps when the 10-year yield goes above 3 or the 30-year yield goes above 4%, expect substantial inflows, because you'll have a lot of insurance companies, pension funds and so on, who will say, well, this may go higher, but I really need that yield right now, and they will go in. So you'll have a temporary cap there. Now, what that does to the term premium will also depend on what happens with equity prices and so on. So it's a whatever I say on that is bound to be wrong.
Right, and whatever you say on this probably too, but very briefly, can you give me a non-farm payrolls guess for next Friday? We have 175 right now on the Bloomberg and 4.9 for the unemployment rate.
I believe that our forecast RG, our forecast is in the 200s.
Yes.
But you know as well as I, it's a totally random number.
Yes.
It will be revised by a double-digit percentage, not only once but twice. And it's a lagging indicator. But the Fed cares about it, so we have to care about it.
Exactly, and at least you're not forecasting some something majorly different to our forecast here in the average. All right, Gabriel Stein, Managing Director of Developed Market Economics at Rubini Global Economics. Thank you for joining us. Coming up, a $6.7 billion bid to take PokerStar's parent, Maya, private, is drawing scrutiny. We'll dig into why a Dubai-based firm is saying an offer of backing was made without its knowledge. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. Time for our latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Stripe says it's raised new financing that values the digital payment startup at about $9 billion. Capital G, the late-stage investment arm of Alphabet, and venture capital firm General Catalyst Partners led a $150 million round. Existing investors, including Sequoia Capital, also took part. Stripe was previously valued at $5 billion. It's raised more than $450 million to date. Ukraine's state-owned energy company says it's ready to buy gas from Russia again. The statement was released hours after Russia's energy minister and the EU's energy chief met for talks in Moscow. They say representatives of the EU, Russia and Ukraine could get together next month to discuss supplies for Ukraine. Ukraine is a major transit country for Russian gas traveling on to Europe. And America's merchandise trade gap unexpectedly widened and inventories declined at the start of the fourth quarter. That's according to advanced data issued by the Commerce Department. The deficit expanded 9.6% last month, the most since March of 2015, to $62 billion. The shortfall exceeded the $59 billion estimate in a Bloomberg survey. And that's your latest Bloomberg Business Flash. Maya founder David Bazov is vowing to push ahead with a $6.7 billion takeover bid for the online gaming company that owns PokerStars. The move comes after a Dubai-based investor said its backing for the deal was given without its consent. Bloomberg editor-at-large Corey Johnson joins us now with more. A very curious tale, Corey. Give us a little bit of the background here.
Yeah, so Amaya is a company formed initially in Toronto, a company out of Quebec, traded in Toronto as a penny stock once upon a time. Did this kind of incredible bid in buying the assets of PokerStars, the very popular or somewhat popular online poker game that is not legal to use in the U.S., but had some great success for a while there. Its success right now is debatable. But the CEO announced a bid for the company and re-announced that bid today. But the curious part of the story is that his partners in the bid apparently had never heard of him or the company themselves and have been dropping like flies. David Bazov is the CEO and founder of this company, or he was the CEO. He did found the company, but he was forced out after an initial bid in February was found to be tainted by some insider trading. He's been charged with insider trading in Quebec. He's been forced to leave the company, nonetheless, yet with another bid for the company today.
So who actually has authority to receive bids or to discuss bids or to actually accept bids?
Yeah, well, it's a publicly traded company. It's got a CEO and a board of directors, and they are supposed to be looking at this bid. Again, he initially announced a bid in February, but there's a curious story as this thing kind of emerged. So Bazov is the largest shareholder. He owns about 17% of the shares, and the stock is traded both in the U.S. and in Canada, so you want to be careful when you're comparing Canadian dollars to U.S. dollars, but trades for about, the bid is about $21 Canadian, which is about $18 U.S. So he made a bid for the company back in February. And in February, he made this bid with an unannounced group of partners. He didn't say who his partners were in the bid or how he was going to be able to afford to buy this company at about a $4 billion valuation. And then that bid kind of sat on the table for a while there. The stock actually traded up going into that. But those bidding partners for this business have been, in these series of bids, have been kind of strange. So $15 a share U.S. he offers initially with an unspecified investor group. Then an outside company, William Hill, a competitor, announced that they were looking at a merger. Both companies talked about it. Then a week later, they pulled away. Then Bazov gets forced out of the company during an insider trading probe. He's being charged with insider trading. 14 people, their trades were also suspended and are being looked at by the Quebec authorities there. And yet he emerges with another $18 a share bid. The stock flies on November 14th with 4 partners. The problem is one of those partners, KBC, had never heard of Amaya. They never heard of Bazov, and they put out this press release saying otherwise. So now, this new offer on November 25th, Head & Shoulders partners. I don't know if you've ever heard of Head & Shoulders. I've heard of the dandruff shampoo, yeah, not the bitters in Hong Kong. Golden Way Capital, never heard of them. But they are the remaining partners, allegedly, with Bazov. And this time, I guess we're supposed to believe them, even though the last time the other bidders that were only 2 weeks ago part of his partnership, at least one of them says they'd never even heard of the guy or the company itself.
Oh, this is the beginning of a great story, Corey, and you know it's not going away. Corey Johnson, thanks. We're definitely going to follow that closely. Still ahead on this Black Friday, we'll hear from the CEO of Hudson's Bay. The company that owns Saks Fifth Avenue has seen its stock fall more than 20% this year thanks to sliding sales. This is Bloomberg. Friday marks the start of the year-end shopping rush. Earlier today, Jerry Stewart, CEO of Hudson's Bay, talked to our John Farrow about holiday retail.
You know, we're focused on delivering a fantastic experience for our customers for the holiday. And, you know, this is Black Friday. It's the Super Bowl of retailing. It's all about having great deals. So we're focused on having great deals and providing terrific customer service.
We spoke to Michael Gould, of course, someone you know, the former CEO of Bloomingdale's, and he talked about how there's an obsession with price at the moment, and maybe too much so, and that in the physical department stores there needs to be more of a focus on things like experience. And stop looking at margins to get price down, but focus on experience. Do you share that view?
We totally agree with him, and especially the part about experience. One of the most dominant forces of our generation is clearly the growth of the Internet, and we think that's great for retailing, great for us, because we're focused on having a fantastic all-channel paradigm that combines the Internet and the stores in a very powerful way for our customers. But one thing is totally clear. If we want customers to come to physical stores, they need to be great physical stores. So we're making the investments for the long term that are necessary for these stores to be terrific experiences. We're going to spend $250 million just on the Saks Fifth Avenue flagship down the street here in New York, just that one store alone. And we're doing that all over the world. In Germany, we bought Galeria Kaufhof last year. We said we're going to spend €1 billion remodeling those stores and making sure that they provide the products that are contemporary that our customers want. So all around the world, our focus is on doing exactly what Mike was talking about, saying a department store can't be your grandmother's department store. It has to be the department store of the future where people want to go because they want to be there. And that's the only way to get them out of their chair and out of their pajamas, buying online, and into the store.
Well, to Mike's point, he goes a little bit further. He says that maybe too much focus, too much money being spent developing the online presence and not enough being spent on in the physical presence. Well, now, do you offset those two things? Do you look at them next to each other, or are they separate focuses?
I'm telling you, the easy jobs are taken. That's why you have to do both.
Yeah.
And there's no way that you can have an inferior online experience and expect to compete against the online-only retailers. On the other hand, we must leverage our true competitive advantage, which is our physical space against them. And so one online retailer I sort of love, a friend came to visit me and said, you know what I really envy? So he said, it's your people in your dressing rooms.
Right.
You know, that you can go to the store, someone can help you, and the customer can try things on. That's a huge advantage, that immediacy, being able to touch it, feel it, see it. But it's not everything. You have to be great on the Internet, too. Some customers are going to choose to be on the Internet. So the way I think about it is the Internet is democratic. It's for everyone, whether you're Internet only or whether you're an all-channel retailer like us. The Internet is a tool like electricity or internal combustion engine that everyone must use in their business. But make no mistake about it, you've got to be great on the Internet to keep the customer. And she chooses what brand she wants to deal with, whether it's Gilt, like you mentioned, or whether it's Saks Fifth Avenue, or whether it's Lord & Taylor, and then she's going to choose. Do I do it online or in the store? Yeah. And we have to do both.
Well, Jerry, this sounds great. But then this is going to cost you. You've got to spend on the online presence. You've got to spend on the physical presence. You've got to focus on price. You've got to get margins thinner, haven't you? Isn't that the direction of travel?
That's why we've been focused on, we say we're a global roll-up of department stores. It's one of the reasons why I've been focused on consolidation.
Yeah.
And that's why we've continued to grow through acquisition. As I mentioned, we bought both Gilt and Kaufhof last year. And it's to add to the scale, because scale is imperative in order to make these investments in both.
Can I bring up a chart of sterling for you just very quickly? At 124.47. The UK is on sale for you right now, isn't it?
Well, it's very interesting what's going on. I think the most immediate impact is that a lot of luxury, it's migrated now where people who can decide where they want to buy it are going to the UK to make those purchases. So it is amazing how capitalism works.
Is there an opportunity there for you in the United Kingdom?
It would have to be the right company at the right price and the right time. But we're much more focused right now. We've made a lot of acquisitions recently at consolidating those and doing a great job with those.
If we can just wrap things up by talking about the politics. The S&P 500.
but not quite Black Friday, even though it's Black Friday. Live from Bloomberg World Headquarters, I'm Bonnie Quinn, and this is Bloomberg Markets. Let's start with the headlines on the Bloomberg First Word News this afternoon. Emma Chandra has that from our newsroom.
Thank you, Ronnie. There appears to be a split in President-elect Donald Trump's inner circle over whom he should nominate for Secretary of State, Mitt Romney or Rudy Giuliani. Trump's advisor, Kellyanne Conway, said via Twitter that some people were alarmed about Romney's possible selection. Former House Speaker Newt Gingrich and former Arkansas Governor Mike Huckabee have expressed opposition to Romney. Green Party presidential candidate Jill Stein is pushing for a recount in the states of Wisconsin, Pennsylvania and Michigan. President-elect Donald Trump won all three of those states. Stein has raised nearly $5 million in her recount efforts so far. China is postponing bilateral meetings with Mongolia indefinitely. This after its North Asian neighbour allowed a 4-day visit by Tibet's spiritual leader, the Dalai Lama. Beijing considers the Dalai Lama to be a separatist leader and routinely condemns nations that give him a platform to speak. And it's the final White House Christmas tree of the Obama administration. First Lady Michelle Obama was there as the tree was delivered. It's a 19-foot-tall Douglas fir from Pennsylvania. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Bonnie.
Emma, thanks. Turning now to Greece, where bankers are working hard to contain the fallout from that deep economic slump. This month, Greek banks have rallied significantly on hopes of a deal between the government and bailout auditors. Earlier in Athens, Bloomberg's Guy Johnson spoke exclusively with ECB Governing Council member and Bank of Greece Governor Yanis Strinaris. Guy asked Strinaris about the health of Greek banks.
The crisis did not start from the Greek banks. They were the victims. The crisis started from the sovereign, and the contagion was from the sovereign to the banks. So they have suffered a lot. Now they are much, much better. They are well capitalized. They have enough provisions. And for the last 2 quarters, we have seen a better NPL development. So things start becoming better even for banks. Profitability has turned to the better in the last quarter. And as the economy recovers, bank profitability and the development of NPLs are becoming more benign.
Right, but it's a very long workout we're talking.
It's a long workout, exactly. Still, there is a stock of NPLs. Of course, NPLs are a problem, but also it's a big opportunity. I mean, we have done simulations in the Bank of Greece and show that if they meet the targets we have set to the banks, then Greek banks will not need more capital. On the contrary, capital will increase. CET1 capital, that is high quality capital, will increase in the next 3 years if they meet the NPL targets we have set for them. And they're quite, I would say, realistic targets.
Okay. We've talked about what's happening on the 4th, which is a focus on Italy. Then we're talking about what's happening in Brussels on the 5th, which is the meeting of finance ministers. Then we've got to the 8th, which the market is waiting for to see what happens in Frankfurt with the ECB meeting. December last year, it could be argued that the ECB did not deliver what the market was looking for, and we saw quite a violent reaction as a result of that. Is there a sense, do you think, on the Governing Council that we do not want to see a repeat of that?
The ECB has delivered. I mean, if you look at numbers, inflation is on the rise in Europe. GDP growth is better than we had before, and we have calculated that the ECB's contribution, I mean the monetary policy contribution, is quite substantial to this effect. So the ECB has delivered. Sometimes markets are very impatient. They want to deliver now. Yeah. As you said, now or never. But the situation is not like that. The ECB takes a long-term stance. You must have trust to the ECB. We are doing the right thing. And on the 8th, we are going to discuss the situation, the new forecast, and then we'll decide what to do.
Has tension grown, though? Is your sense that tension has grown as a result of the fact that bond yields have risen, and as a result of which there isn't maybe the same requirements to change the parameters of the programme?
Well, it is... It is true that bond prices and bond yields have changed. We are entering perhaps a new era. The numbers show that our policy works. Inflation is on the rise, as I said before. We look at all this data on the 8th of December, and we will decide. I mean, of course, monetary policy will continue to be accommodating until inflation arrives at a desirable level, which is 2% or slightly lower.
But now is not the time.
Still a long distance from this target.
So far too early to be talking about the T word, the tapering word.
It's far too early, exactly.
One thing we have seen as a result of Donald Trump's election has been a steeper yield curve. Is that desirable in your mind?
From the bank's point of view, it is, yes. I think it is a desirable effect.
Because it helps the banks?
It helps the banks.
But it does raise borrowing costs?
Yes, but if growth also goes up, it does matter. Because now the most important problem is low growth. If growth improves, it is expected that bond yields will be on the rise.
You talk about rising inflation, and even in the 5 years point to the fact that even quite some way out, inflation is not going to get back to target. That's something that the market is pricing in at the moment, and your data seems to indicate, and your forecasts seem to indicate something as well. Janet Yellen talks about running a hot economy. And she has seen this, and it'd be interesting to know what she thinks now, but she thinks that overshooting on the inflation story is maybe something that central banks, or her central bank, should think about. Is that something that the ECB can think about as well?
No, not yet. Not yet. The cycle differs now in Europe compared to the United States. We're in a different phase of the cycle.
But do you think it would be desirable to point out to the markets that even if once we get to inflation targets, that actually running even beyond that a little bit will be something that the bank would tolerate?
No, we haven't discussed this thing at all.
Just one final quick question, Governor. When do you anticipate, and we've seen a big drop in Greek bond yields, we're through 7%, which is a kind of really important line in the sand. When do you think we're going to see Greek bonds being included in the QE program?
Well, this is up to the Governing Council of the ECB to decide. Let's see what happens on the 5th of December. And if we have something concrete on debt, then we'll take a decision.
And that was Bank of Greece Governor Yanis Stournaris speaking in an exclusive interview with Bloomberg's Guy Johnson. Well, Macy's finishing down the session 1.7% on the day. It did suffer some website service disruptions this Black Friday, which is dealing a setback to Macy's, trying to persuade shoppers it can handle e-commerce. So just a few minutes ago, I went to the website and tried to buy an item, and it put me onto a page where it said there were service disruptions and gave me a countdown clock. It actually appears to be working again now, and we are looking for comment from Macy's. I will be removing that Dyson vacuum cleaner from my shopping bag right now. But there we go. So not smooth sailing for all the retailers this Black Friday. Coming up, President-elect Donald Trump's name may be coming down from the Trump International Hotel and Tower in Toronto. We'll tell you why. This is Bloomberg. Bloomberg Markets. I'm Vonnie Quinn. Let's head straight over to Bloomberg's Abigail Doolittle. She's got a chart of the day. Abigail.
We have got a great chart of the day here, Vonnie, and it deals with whether or not the recent rally in stocks to record highs. We do, of course, have the S&P 500 Dow closing at record highs once again for the fourth day in a row, whether or not this rally can continue. We go into the Bloomberg and we take a look at hashtag BTV 4748. Here we have a roughly one-year chart of the S&P 500. The S&P 500 is on top, and we see it trading near the record highs all the way over to the side there. Now, on the bottom, we have the RSI, or the Relative Strength Index. This is basically an indicator of momentum. Many traders and investors use this as a signal to buy or sell stocks. And typically, when the RSI on a security or an index reaches 70, that's considered to be an overbought or a sell signal. Now, just today, we do have the RSI and the S&P 500 climbing above 70, so certainly hitting that sell signal. And we can see that it's been pretty reliable, trading between 70, the sell signal, and 30, the buy signal, over the last year or so. So this chart may, in fact, suggest that there could be some declines ahead for the S&P 500. Timing, of course, is difficult. And one chart that may confirm this possibility of a pullback for the S&P 500 from a different angle is volume. Once again, we have the S&P 500 up on top. On bottom, we have the volume, and we see that into and after the election, it had been pretty high, but after the election, 2 days after the election, it has started to decline. So basically, we have fewer buyers buying the rally, less enthusiastic buyers, perhaps suggesting that that RSI sell signal is something to pay attention to, and that there could be, Vonnie, a pullback ahead for the S&P 500 and stocks overall.
Great chart. Thanks, Abigail. Thanks for that. It is time now for our latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Lufthansa is putting a new offer on the table in an attempt to end that three-day strike by pilots. The German airline is offering the pilots a raise tied to reform of the company's pension system. The strike has forced Lufthansa to cancel more than 2,600 flights. It's expected to continue through tomorrow. The Macy's website has suffered service disruptions this Black Friday. The development is a setback for the company trying to persuade shoppers and investors that it can handle e-commerce. Some visitors to Macy's.com were redirected to a page citing, quote, heavier traffic than normal, with a countdown clock telling shoppers when they could return to the main site. Macy's hasn't immediately responded to a request for comment. And European Union regulators are in settlement talks with banks suspected of rigging currency markets, according to people familiar with the case. It's part of an investigation that's already led to multi-billion-dollar fines in the US and UK. Barclays and HSBC have previously said their currency trading was being reviewed by the EU. And that's our latest Bloomberg Business Flash. I do want to mention some breaking news now. U.S. Senator for Connecticut, Richard Blumenthal, has sent a letter to the Attorney General, Loretta Lynch, saying that a special counsel is to be called for to prevent conflicts under the president-elect Donald Trump. So once again, Senator Richard Blumenthal has released a statement which says he has sent a letter to the Attorney General, Loretta Lynch, and that letter calls for a special counsel in order to prevent Trump conflicts. All right, Trump International Hotel and Tower in Toronto is being pitched for sale with a suggested price of at least $222 million, though there's no guarantee the U.S. president-elect's name will stay on the building. Bloomberg News' Katya Dmitrieva wrote the story and joins us now from Toronto. Why is the building being sold, Katya? Let's start there.
Well, this is just the latest in the Trump-Toronto Towers saga here. Even just a few weeks ago, there was a huge protest that took place and shut down Bay Street, which is essentially Toronto's Wall Street. And it's been plagued with issues going back all the way before it opened in 2012. So we had construction delays, we had accusations of mismanagement, both from the Trump organization, from the developers. And so JCF Capital came in, purchased the debt on the property, and is now telling the developer, well, we're going to put the property in receivership to take our money back. And by the way, bidding starts at about 300 million Canadian.
300 million Canadian. Wow. Well, why are the brokers marketing the building and, with the caveat that the name might stay, it might not stay? How can you even market something like that?
Well, I think the idea is that the Trump name in Toronto, you have to realize we pride ourselves on multiculturalism here in the city and in Canada. And so when you have a candidate who last year was making disparaging remarks, that made a pretty big deal here in Toronto. We had protests again last year. Almost every single weekend, the street was being blocked. And so if you have a buyer who, so far, we've heard a lot of Chinese funds have interest in this property. If you have a buyer who also thinks that way, then it's good to know that they could potentially be able to take the name from the tower. What we don't know is what kind of contracts are in place. So, for example, what would be the fee for cutting that contract with the Trump brand, as well as just getting the name off of the tower?
Right, and it just puts in my mind the west side of Manhattan, where the name just came down after a long time of tenants sort of pitching that the name should come down from their buildings on the west side highway of Manhattan. So what would be next for the building? I mean, assuming the name comes down, does it sell as a luxury building just as highly priced as it would have been?
Absolutely. So the two funds that we've heard are interested so far are Blue Sky and Great Eagle. And what I'm hearing is that they might actually want to take that and make it into a different kind of five-star hotel brand. There are a few we already have in Toronto. We have the Four Seasons, for example, but there are a lot of brands that aren't here, and that could potentially happen. We could sell the property, and a lot of the condos are still available. A lot of the hotel units that were used as investments are still available. So the end buyer might have to negotiate to purchase the entire building, so from the people who already own condo units and hotel units, and rebrand it entirely as a new hotel.
Are there any other Trump buildings or Trump hotels that are sort of seeing the same problems, or is this a particular instance?
Well, in Vancouver as well, the Trump Tower just opened, and in fact, Donald Trump actually mentioned this tower. He said, we have a beautiful building that just opened in Canada, and you should come and see it. And this was the Vancouver Tower he was referring to. That one's a bit different. It's been quite successful from what I hear. A lot of the condo units have sold on the brand name alone, but there is also a local councillor in Vancouver calling for the removal of the Trump name. And in fact, someone climbed that tower earlier last year after Donald Trump made comments about Mexicans. So there is some controversy in that city as well.
Bloomberg's Katia Dmitrieva, thank you for that. Well, it is official now with a statement. President-elect Donald Trump announcing his selection of Katie McFarland to serve as Deputy National Security Advisor. We're also learning in the last few minutes that Donald F. McGahn will serve as assistant to the President and White House counsel. He's a partner at Jones Day, former chairman of the Federal Election Commission. Went to the University of Notre Dame, got his bachelor's, and Widener University, he got his JD. So once again, this is Donald McGahn, going to be assistant to the President and White House counsel, and Katie McFarland, as we learned earlier, going to serve as Deputy National Security Advisor. We knew there would be two staff picks today. They have now come out. We know that the President has at least 8 meetings on Monday, including a meeting with John Allison, former BB&T CEO. A second meeting there coming up. Just how vulnerable is America's energy infrastructure? And is building more pipelines the answer? This is Bloomberg. Bloomberg Markets, I'm Vonnie Quinn. 2 accidents in Alabama show how heavily millions of Americans rely on the Colonial Pipeline for gasoline. Bloomberg Businessweek reporter Christopher Leonard talked to Carol Mather about his investigation into the pipeline.
This pipeline was built in 1962, and at the time it was built, it was the largest private sector infrastructure project in U.S. history. And it's a 5,500-mile pipeline that serves a really vital role in the U.S. energy infrastructure. The pipeline begins down in Texas and Louisiana, where there's a large concentration of oil refineries, and it takes finished fuel products like diesel fuel and gasoline all the way across the southeast, up the eastern seaboard from Atlanta up through New York, and then ends in New Jersey. And amazingly, about half of the fuel used along the East Coast is transported through this single pipeline. About 50 million people a day depend on it for fuel.
Right. I think you said something like 1.4 million gallons of gasoline every day kind of going through the pipeline.
That's right, and that's just the line that carries gasoline fuel that you'd put into your car. There's another line that carries an equivalent amount of diesel fuel and other fuel products as well.
Now, Chris, if you didn't know about the Colonial Pipeline, this Halloween you probably learned about it because it was a big story. There was an explosion there. What happened?
Exactly. Well, what's really interesting about what happened on Halloween is it was a sort of follow-on effect from a large accident that happened in September. Back in late September, this pipeline sprang a leak, essentially, in the state of Alabama, and about 330,000 gallons of gasoline went spilling out into the surrounding woodlands. That accident in September really underscored the importance of this pipeline. They had to shut off the gasoline flow, essentially, when that leak was discovered. And when that happened, gasoline reserves on the east coast of the United States plunged at their fastest level in U.S. history. Stocks fell all across the eastern seaboard as gasoline stations realized that they weren't getting backup supplies to come. So Colonial started to try to fix this leaky section of pipe that sprang a leak in September, and they hired a crew in October to start doing permanent fixes on this aging section of pipe. And what happened on Halloween was really tragic. We don't have all the details yet, but what we know is that a crew of 9 men was excavating earth around the pipeline, and somehow the earth-moving track hoe machine that they were using struck the pipeline. It exploded. A column of flame shot more than 50 feet in the air. 1 worker was killed immediately on the site. 4 other construction workers were terribly burned and taken to the nearby town of Birmingham to be treated. And once again, we saw that the flow of gasoline was immediately stopped.
And unfortunately, I hate to say this, but you're going to have, I guess, accidents in any industry. But what's worrisome, Chris, and you put this in your story, is that there's been an increase in the number of accidents or explosions that we're seeing at the Colonial Pipeline just in the last 12 months alone.
Yeah, that's right. I mean, as you can see, we're dealing with an aging piece of infrastructure. It's about 50 years old. But in Alabama particularly, something seems to be going on with the Colonial Pipeline Company. They've had 6 incidents, 6 leaks this year alone. Now, that's as many leaks as they had in Alabama for the previous 5 years altogether. So there has been a sharp increase in incidents just in Alabama. The company would not comment to me at all as to what's driving that increase. We do not know what's going wrong in Alabama at this point that is causing all of these leaks. But then when you pull back and look at the pipeline structure as a whole, you are also seeing an increase in accidents year over year. And maybe even more concerning, you're seeing that these accidents are getting more and more expensive and doing more and more property damage. Now, Colonial, federal regulators, the National Transportation and Safety Board are all investigating this at this time.
Right.
But they wouldn't tell me what is driving this increase in accidents.
And you can check out that story in the latest Bloomberg Business Week. I want to give you an update on Macy's because the website had been experiencing delays and pushing customers to a queue, basically. We have a statement now from Macy's saying that they're still taking a high volume of online orders and are working quickly to alleviate the delay issue. Black Friday deals are available until midnight Saturday. Thanks for watching Bloomberg.
Welcome to Bloomberg Business Week. I'm Carol Masser.
And I'm Oliver Rennick. We're coming to you from inside the magazine's headquarters in New York.
In this week's issue, how vulnerable is America's energy infrastructure? And is building more pipelines the answer?
Plus, Paul Manafort is back. The controversial former campaign manager for President-elect Donald Trump never really went away, though.
And how the military is inspiring IBM cybersecurity training.
All that and more ahead.
We're here with Bloomberg Business Week editor Jim Ellis. And Jim, I want to start in the global economics section because Europe is really getting for kind of this super election cycle underway. And we're watching very closely a referendum in Italy.
Yeah, people are looking at Italy simply because it's a good barometer of the way that the voters across Europe sort of think about
how happy they are with their government. So right now, even though the referendum is about something that seems fairly arcane, which is changing the way that the parliament is set up in Italy and really cutting down the number of senators there. One of the things about Italian politics is that we always seem to have lots of governments turning over, and one reason is that they have over 300 senators. They're cutting that down by about 2/3. What that's going to do supposedly is streamline government, but it also allows lots of things within government to change, and it sort of tells you whether people are angry enough that they really substantially want big changes in government. If that happens, you're probably going to see it across the continent in places like France that also have more important elections later this year.
Italy often a trendsetter for what happens on the continent.
You guys phrased it as sort of a petri dish, so that's what's going to be really important here is whether or not this sort of globalization is coming to a halt, whether or not this populism continues to extend throughout Europe.
Well, that's one of the problems, that populism has gotten a really big boost simply because there have been big employment problems. People are worried about immigration, and also security is an issue. So we've got to figure out just how angry people are and how much change they truly want. Italy will be the start of that.
Okay, let's move it to a slightly less serious topic, but a great story about Zara, about clothing.
I love this story.
And I love it. And the clothes aren't too bad either. So.
It's a fascinating story because sort of quietly over the last 40 years, Zara has gone from a single store in northern Spain to being the largest fashion retailer in the world. I mean, what they do, though, is very different than others because typically in a fashion empire, you think of there's a style doyen, somebody who's sort of out there saying this is what people will wear. They flipped that upside down, and instead they have 350 designers who are there in Spain, northern Spain, and they sit around and they try to figure out what's hot. They use data, they use information they get from countries around the world. Every night they're getting information from websites about what's selling, what's hot, what people are clicking on, but also they're getting information from consumers in big major markets like Moscow, New York, Tokyo, and they take that together and then they try things. What they've done is they've moved a lot of their production capacity to Spain. That doesn't sound smart because it's Spain, but what happens typically in fashion is you're sourcing from the Far East and it takes months to bring it by boat to the markets where you want to sell it. They can do it much quicker, so they can turn fashions in a couple of weeks. They're refreshing every 2, 3, 4 weeks in stores, and what happens is people think, it's new, I've got to buy it. That's very different. There's no more of that seasons. There's 4 seasons a year. Right. No, this is 24/7 fashion.
Let's talk about the environment. One big event that impacted the environment. That's the cover story about a pipeline explosion. Tell us about this narrative.
It's an interesting story because this one pipeline basically carries gasoline for about 50 million people. We're really dependent on it, but increasingly pipeline safety has become an issue, and we're seeing it now with the Colonial.
And reporter Christopher Leonard actually visited the pipeline, and we caught up with him.
This pipeline was built in 1962, and at the time it was built, it was the largest private sector infrastructure project in U.S. history. And it's a 5,500-mile pipeline that serves a really vital role in the U.S. energy infrastructure. The pipeline begins down in Texas and Louisiana, where there's a large concentration of oil refineries. And it takes finished fuel products like diesel fuel and gasoline all the way across the southeast, up the eastern seaboard from Atlanta up through New York, and then ends in New Jersey. And amazingly, about half of the fuel used along the East Coast is transported through this single pipeline. About 50 million people a day depend on it for fuel.
Right. I think you said something like 1.4 million gallons of gasoline every day kind of going through the pipeline.
That's right, and that's just the line that carries gasoline fuel that you'd put into your car. There's another line that carries an equivalent amount of diesel fuel and other fuel products as well.
Now, Chris, if you didn't know about the Colonial Pipeline, this Halloween you probably learned about it because it was a big story. There was an explosion there. What happened?
Exactly. Well, what's really interesting about what happened on Halloween is it was a sort of follow-on effect from a large accident that happened in September. Back in late September, this pipeline sprang a leak, essentially, in the state of Alabama, and about 330,000 gallons of gasoline went spilling out into the surrounding woodlands. That accident in September really underscored the importance of this pipeline. They had to shut off the gasoline flow, essentially, when that leak was discovered. And when that happened, gasoline reserves on the east coast of the United States plunged at their fastest level in U.S. history. Stocks fell all across the eastern seaboard as gasoline stations realized that they weren't getting backup supplies to come. So Colonial started to try to fix this leaky section of pipe that sprang a leak in September, and they hired a crew in October to start doing permanent fixes on this aging section of pipe. And what happened on Halloween was really tragic. We don't have all the details yet, but what we know is that a crew of 9 men was excavating earth around the pipeline, and somehow the earth-moving track hoe machine that they were using struck the pipeline. It exploded. A column of flame shot more than 50 feet in the air. One worker was killed immediately on the site. 4 other construction workers were terribly burned and taken to the nearby town of Birmingham to be treated. And once again, we saw that the flow of gasoline was immediately stopped.
And unfortunately, I hate to say this, but you're going to have, I guess, accidents in any industry. But what's worrisome, Chris, and you put this in your story, is that there's been an increase in the number of accidents or explosions that we're seeing at the Colonial Pipeline just in the last 12 months alone.
Yeah, that's right. I mean, as you can see, we're dealing with an aging piece of infrastructure. It's about 50 years old. But in Alabama particularly, something seems to be going on with the Colonial Pipeline Company. They've had 6 incidents, 6 leaks this year alone. Now, that's as many leaks as they had in Alabama for the previous 5 years altogether. So there has been a sharp increase in incidents just in Alabama. The company would not comment to me at all as to what's driving that increase. We do not know what's going wrong in Alabama at this point that is causing all of these leaks. But then when you pull back and look at the pipeline structure as a whole, you are also seeing an increase in accidents year over year. And maybe even more concerning, you're seeing that these accidents are getting more and more expensive and doing more and more property damage. Now, Colonial, federal regulators, the National Transportation and Safety Board are all investigating this at this time.
Right.
But they wouldn't tell me what is driving this increase in accident.
Turning the Colonial Pipeline explosion into a cover image was the job of creative director Rob Vargas.
This obviously references the explosion that happened in October with the Colonial Pipeline. And it was hard to get an image of that because it happened very quickly and because they set up a very wide perimeter around the area. And so we wanted to get a cross explosion, but we didn't have a photo, so we just obviously turned to Photoshop as we usually do. And so, we created this warning sign, warning exploding pipeline, and it says may result in hellish blaze and massive damage to the U.S. gasoline supply. So just stating it pretty plainly.
Right.
And then beyond that, we just, sort of emphasized the fire, on the background.
Well, yeah, you really emphasize the fire. It's not often, right, that you guys just take an image and just kind of blow out, the cover, and it's just everywhere.
Yeah. I mean, from the images we did see, which were from afar, it did look like a small nuclear explosion. And so it seemed like a very massive, intense blast. And so we wanted to sort of get at that without showing you sort of a news photo from afar.
I think also what's good about it is, of course, when you have a pipeline explode, there's a lot of different impact, but you also point out that the company itself here is also exploding as a result.
Yeah, exactly. I mean, this company is they've had a few incidents, and so we wanted to make sure to get their name on there as well.
Up next, hedge fund billionaire John Paulson bet on Donald Trump when most of Wall Street said no thanks. Now he's reaping the rewards.
And why some of Hillary Clinton's supporters on Wall Street are changing their attitudes about a Trump White House.
Welcome back to Bloomberg Business Week. I'm Carol Masser.
And I'm Oliver Rinnick. In the markets and finance section, hedge fund billionaire John Paulson is seeing a huge payoff thanks to his bet that Donald Trump could win the election.
I spoke to reporter Joe Light.
He's one of the biggest hedge fund managers in the world now, and he's famous for a big short he made before the financial crisis against subprime mortgage bonds. Made him famous, made his funds billions of dollars, and now he's moving on to other issues.
Other issues, and this time we're talking about Fannie Mae and Freddie Mac that he's also had some interest in for a good reason.
That's right. So Fannie Mae and Freddie Mac, they're at the center of the U.S. mortgage market, and there were a couple companies that were taken over by the government in 2008 and eventually received nearly $188 billion in taxpayer bailout money. Now, a curiosity about this bailout is even though the government took over the companies, they left a lot of Fannie and Freddie common shares and also some preferred shares outstanding. So at the time, they seemed worthless. The government has been taking all of Fannie and Freddie's profits since the crisis. But as the mortgage market started to turn and as the real estate market started to turn, certain investors, Paulson among them, although we don't know when he bought his shares, started to see some value there and scoop the shares back up.
So he's making money on it, correct?
That's right, or at least the share prices have risen a great deal since the trough of the crisis. One of the difficulties for Paulson and other investors is that the current terms of Fannie and Freddie's bailout requires them to send all of their profits to the U.S. government. So one of the things that they've been lobbying pretty heavily around, and there are also lawsuits around, the shareholders are suing the government, is to try to change the policy of sweeping all the profits and see at least some of those profits start flowing to shareholders again. But it's very much an outstanding question whether the administration or Congress will let that to happen, and also with the court cases, whether the courts will start to change that policy.
Well, Joe, and this is kind of where your story gets interesting. First of all, Freddie Mac, Fannie Mae, I mean, I think it's always, everybody's been trying to get their head around them for years, even before the crisis. You know, are they government agencies, kind of quasi-government agencies, and yet there are investors. They're publicly, or they were publicly held entities. So here is kind of interesting. Paulson made a bet, John Paulson made a bet on Donald Trump, right? He was out there, you know, kind of early backing Donald Trump. So it is curious to see what kind of leverage he will have in kind of making Donald Trump or his administration maybe be more favorable about Fannie and Freddie. Maybe more of those profits will ultimately go back to shareholders. In the meantime, John Paulson has been spending some money lobbying or supporting Donald Trump and his affiliated campaigns, if you will.
That's right. So Paulson became involved in the Trump campaign, as you said, pretty early on when it seemed like Trump didn't have a chance of winning the presidency. He helped host, or he's given more than $300,000 to not only Trump but also to the Republican National Committee and different Republican organizations. But even before becoming involved with the Trump campaign, Paulson and Company has been spending hundreds of thousands of dollars on lobbyists, basically trying to, get in the halls of Congress, get in the ear of lawmakers who have influence on proposed reforms to Fannie and Freddie, and to try to convince some of those guys to change the policy in Congress. Fannie and Freddie, it doesn't fall along the partisan lines that many issues do. There are Democrats who want to save Fannie and Freddie, Democrats who want to eliminate Fannie and Freddie, and same on the Republican side, on both sides. So they've been trying to convince some lawmakers to go to bat for what Paulson would say are the rights of shareholders in these companies and their rights to a share of these companies' future profits.
Also in the market section, why some Clinton supporters on Wall Street are coming around to the idea of President Trump.
We spoke to reporter Max Abelson.
The reason they're turning around isn't because they suddenly, dislike Hillary Clinton and they suddenly love Donald Trump. The reason that they're turning around is they think that they're going to have things go really, really well for them and for their wallets. Under Donald Trump, they're expecting tax cuts. They're expecting Wall Street to be deregulated. They're expecting interest rates to go up. And, you know, they might have had their feelings hurt during the campaign when Trump was making fun of them. But now I think they know where to look, and it's their wallets. And I think it's, you know, it's out of self-interest that they're getting happy. We had one person say to us, look, you know, I really am upset about the things Donald Trump says about Muslims, the things Donald Trump says about women, the things Donald Trump says about immigrants. But, you know, I to get greedy, I look at what's going to happen to me and to my family, and I know that these are going to be good times. And it was amazing to hear someone say that to me, you know, in an interview. But at least he was being honest. You know, at least he was saying what I think a lot of people are feeling, which is that, you know, if you work for a big bank, you have come through this sort of era when, you know, bankers had to deal with a lot of regulation. The Dodd-Frank Act was put in place, you know, to prevent another global financial crisis, and it meant that some of the rules of the road were going to change. And I think people are going to expect now that those rules are going to change again, and are going to make life for the big banks a lot easier.
You know, it doesn't take a genius to look at Trump, think about what he talks about, and think about whether or not it's going to be good for financial markets and banks in general in terms of regulations. So why then this sort of sudden epiphany that, oh, this guy's actually going to be great for us? They had to have kind of known that along the way, but yet was it just the social policies, the sort of toxicity of supporting Trump in a major urban area? How come the sudden change of heart?
Right. I think a lot of people just simply didn't think he was going to win. And they're preparing for a Clinton presidency. Now, I think there's also a third dynamic, which is that, and this hints to what you're talking about when it comes to specificity. Trump is inconsistent. So, for example, he talks about rolling back Dodd-Frank, which is sort of what I'm referring to here when I say that, you know, the bankers expect life is going to get better for them. He talks about rolling back Dodd-Frank. On the other, and of course, doing things like putting in a moratorium on new regulation. On the other hand, the Republican platform for 2016 has in it that there's going to be a new Glass-Steagall, which of course would be really disruptive to Wall Street. Just to remind people, Glass-Steagall put up a wall in the wake of you know, the 1929 stock crash when the Great Depression started, to put up a wall between commercial and investment banking. And a new Glass-Steagall would be pretty annoying for Citigroup, which was basically put together with travelers. The only reason Citigroup exists is that they, you know, actually when Citigroup was created in the late 1990s, they were really doing it illegally. They were doing it with the expectation that the Glass-Steagall wall was going to come down, which in fact it did, which is why we still have Citi. So if that comes back, you know, these banks are in trouble. And I think that to be able to square the circle, you can say that the bankers really believe when Trump says he's going to like lower their taxes and deregulate their industry, and I think they do not believe him when he sort of says this populist sort of rants against Wall Street, and the Republicans suggest there'll be a new Glass-Steagall. I think that's my understanding after speaking to these people.
Up next, do autocrats know how to lead a democracy? We'll take a look at what's happening around the world.
Plus, Paul Manafort reemerges as a major player in Trump Tower.
Welcome back to Bloomberg Business Week. I'm Carol Masser.
And I'm Oliver Rennick. You can also listen to us on the radio at Sirius XM, channel 119, and also on AM 1130 New York, AM 1200 in Boston, 99.1 FM in Washington, D.C., and AM 960 in the Bay Area.
And in London on DAB MUX3 and in Asia on the Bloomberg Radio Plus app. In the feature section, a controversial figure in Trumpland reemerges in Trump Tower.
That's right, Paul Manafort is back, but it turns out he never really left. We spoke to reporter Bob Kolker.
Paul Manafort, before Steve Bannon came along, was supposed to be the big mastermind who was going to bring Trump a victory. And when he resigned in August, it seemed like that was going to be it, and his big fall from grace, and we would never hear from him again. But in fact, in Bloomberg Business Week, what I've reported out is the idea that he never went away, that he stayed close to Trump all the way through, and that in fact it was he who articulated the strategy that brought Trump the victory. That Steve Bannon was very good at making a lot of noise with, fringe groups, but in order to get the real, center of America to go on Trump's side in the key states that he needed it, that was all Paul Manafort. And it just speaks to his power as sort of an unseen force in politics for decades. And so I take a look at it, the scope of his career, and evaluate what might be in store for him in the future.
Well, that's what's interesting, I find. Paul Manafort, the Trump administration, we're assuming he's going to be a bit anti-establishment, but that doesn't necessarily seem like that's how it's going to ultimately work out. Paul Manafort, to me, Bob, seems to be the ultimate Washington insider and establishment.
Absolutely. Insider's the perfect word for him. This is someone who came up in the 70s in young Republican circles and helped with the Gerald Ford campaign and then with the Ronald Reagan campaign, and then flipped over to the lobbying side and invented the culture of lobbying that Donald Trump seems to, make a lot of noise about not liking. But it was Manafort who, brought all of these controversial foreign figures access to the Reagan and Bush White Houses, people like Ferdinand Marcos. And then it was Manafort who, worked on the Dole campaign in 1996. And it was Manafort who Trump turned to because he couldn't find anyone else to help him when his primaries were slumping and it looked like the end for him last spring.
He sort of unintentionally maybe invented this, or rather popularized the phrase influence peddling as a synonym for lobbying.
Right. I mean, the irony of this election season is that Paul Manafort was very visible, but most of the time he likes to be below the radar and invisible. He's a flashy, well-dressed guy, but he's not a public guy like Lee Atwater was back then, or Roger Stone. He's not flamboyant. And so when he was brought into Congress during this HUD scandal in the late 80s, he played a part in the directing of federal funds for a project in New Jersey. He actually said flat out to the public that some call it lobbying, some call it influence peddling. It's just a matter of how you define it. And that was kind of a glib statement that would define his career. Mm-hmm.
He's made a lot of money doing this. I mean, you kind of profile, like he is a nice dresser. He's got homes like around the country and some really lovely places. What's interesting, though, is he is a low-key guy, but he is involved, from what we're hearing, still in the Trump administration and the forming of what's to come.
Yeah, in the final days of the campaign, he was in touch directly with Trump about how to handle the Jim Comey revelations that the FBI was going to look again at Hillary's emails. And more closer to the final days, he was one of the ones who was saying, you've got to go back to Michigan. You could win Michigan. And sure enough, Trump did win Michigan.
Tell us a little bit more, because you have some great details in the story about their background, how the two got to know each other, Trump and Manafort.
Well, they first met personally in the 70s through Roy Cohn, of all people. I mean, this is like Ragtime, or one of these like works of fiction where all the famous people meet each other or cross paths. But then, he used Manafort's firm as for lobbying purposes to defend his casinos against Indian casinos that were going to come up. And so he knew Manafort that way. And in the 1988 convention, when Manafort was in charge of the Republican National Convention that would bring George Bush a victory, Trump actually came and visited him there and took a look at the campaign operation, the trailer at the convention, asked questions, said he was very impressed, started to get a feel for the sort of thing Manafort did. Years later, Manafort has a home in Trump Tower. They probably see each other in the elevator from time to time. At least two friends of his say, you got to get Manafort to help you with the campaign. And he calls him and picks him up and
the rest is history.
Up next, why Trump's conflicts of interest may become the new normal.
Plus, the fear gripping over 700,000 immigrants currently shielded from deportation in the U.S.
Welcome back to Bloomberg Business Week. I'm Carol Masser.
And I'm Oliver Rennick. Still ahead, taking clues on how Donald Trump might run his presidency by looking at autocrats around the world.
And why it might be impossible for President-elect Donald Trump to remove his conflicts of interest.
And the main tool that corporations have to fight sexual harassment.
It's all ahead on Bloomberg Business Week.
We're here with editor Jim Ellis, and there are so many must-reads in this week, as always. One that's particularly interesting is about what's happening in London, and in particular, Chinese investment within London. It seems like a strange time to be doing that.
It's a strange time, particularly given that, post-Brexit, so many people are worried that London's time as a financial center is at risk, and that a lot of people are talking about not investing in London or reducing staffs there, and so rents are going down, and the thought of bringing up new buildings is a little scary to most developers. With that in mind, enter the Chinese, who've decided that a bunch of Chinese banks, 4 big ones, are putting money behind a huge financial services development in London that will basically be the home for lots of Chinese businesses in London. They continue to believe that London's going to remain a big financial market, and also they can also play the fact that maybe they can make a lot of money on the real estate as well. And so it's sort of counter-programming, but sometimes if it works really big.
2 words, Canary Wharf.
Yes, well, we won't go there, right there. They're hoping that won't happen. They really do think that because they have so many of their own companies that need to have big London outposts, that gives them a floor.
All right, let's talk about something, too, in the technology section. This is an Uber wannabe who said that they had raised a lot of money, but they hadn't. And it's a serious story, but there's some fun elements to it. We're talking about Carhu.
Carhu. It's a fun story because we hear so many people who want to get into the ride-hailing startup business, and this company certainly had a lot of press. It's based in London. It was supposed to have raised $250 million. It turns out, when all is said and done, that they really only raised about $40 million.
Big difference.
But they spent as if they had raised $1 billion. They were spending big on offices, on multiple continents. That they had parties. They had, the CEO had a party in Las Vegas that had everything from free-flowing champagne to exotic dancers, all this on the company dime. As well, there were cars, there were all the things that gave the impression that there were big money was here, and it turns out that it did not work. And at the same time, the app that this was all supposed to go for didn't work as well. So this is a true story of the investors and markets getting ahead of themselves.
All right, let's talk about something in the opening remarks section, which looks at how we might be able to ascertain what Donald Trump is going to do as president. You guys look to a particular type of leader, these sort of autocrats that already in place around the world.
Right. I mean, what was interesting about that is that everybody keeps saying, Donald Trump, we've never seen anything like him, so we don't really know how to react to him. Well, it turns out that this whole notion of an elected autocrat has actually been done a number of times across Europe. And everyone from Mussolini on, we've seen it there, we've seen it in Italy, we've seen it in Russia with Putin, and people who basically have come in with very strong sort of right-wing authoritarian leaders, but who've gotten elected to those posts as opposed to just seizing power. And we try to, in OR, take a look at what are the common themes there, and that sort of gives you a hint of whether we could see Trump follow the same thing.
Hey, well, we're talking about Donald Trump. In politics and policy, you guys take a dive into why kind of unwinding Donald Trump from all of his business interests is not going to necessarily be so easy.
It's going to be almost impossible. I mean, one of the problems is that Trump is his business. I mean, basically what Trump is a giant licensing machine that trades off of him and his persona. That makes it very difficult to think about how you can take the Trump off all these buildings that are there trying to get people to pay more for rents or office space because it has Trump's name on it. And a lot of those might contractually need to have him involved. The other thing is that he doesn't want to separate his businesses, so that's a big problem. He wants to basically maintain all of his structure and just keep his children running them. I won't even say the word conflict of interest, but we've never had anything quite like this before. What's happened in the past is that presidents typically take their assets and put them in blind trust.
Very little precedent, but a lot of questions. We spoke to reporter Caleb Melby.
So, Caleb, you kick off your story saying that if Donald Trump kind of sold all of his business interests, it would kind of get rid of the conflict of interests problem. Kind of walk us through that a little bit.
Right. So right now, what everybody seems to be talking about is political opponents, the media. He has these business partners coming to visit him in Trump Towers. He's making these transition decisions. And more importantly, going forward, he's going to have all of these business ties with these guys and others, as well as ties to lenders. And everybody is really concerned about how that could affect how Trump governs, what his statecraft looks like, and all of that's up in the air. And so what we're trying to figure out is what, if anything, he could do to try and distance himself from those businesses that could potentially pose a lot of problems and minimally just keep everybody questioning why he's doing what he's doing as he engages in countries where he has these business ties.
And yet selling his businesses are not so easy, right?
No. Trump's businesses are, as is known at this point, incredibly unique. So, like, you have the Trump golf courses, and you have his licensing deals with these international partners, where he's giving his name to owner developers of buildings, and they put his name on the building in hopes of getting higher prices for condos or hotel rooms. And it's really hard to separate Trump the man specifically from that business, right? Like, do I want to own the rights to put Trump's name on things when I am not Trump and don't get to control what Trump does or what Trump does as president? And then there's other things where he's a minority partner in a couple of buildings with Vornado. He would need to get their permission to sell that. A whole bunch of quibbles and quabbles in trying to sell these businesses.
Also in the politics section, the fear gripping immigrants working in the U.S. legally. We spoke to reporter Josh Idelson.
Josh, you begin your story talking about an individual, Gabe Belmonte. Who is he and why is he nervous?
So he's in his 30s. He's an engineer at a Silicon Valley company.
and he doesn't know whether he's going to lose his permit to work and his protection from deportation within the next couple months. He's someone who, in many ways, could be a poster child for President Obama's DACA, Deferred Action for Childhood Arrivals program, who was brought here as a 7-year-old on a visa that he and his family then stayed past the expiration of, has spent almost his whole life in the United States, and wasn't able to work legally until 2012, when he was covered under this program initiated through executive authority by President Obama, which so far has shielded over 700,000 people who've been here a long time and came here early in their lives from being threatened with deportation, and has provided them work permits. So he actually hesitated, he told me, about applying for the program in 2012 because he worried about what would happen if Mitt Romney got elected. Now he's in this position of reckoning with what this unexpected victory by President-elect Donald Trump is going to mean for him.
And his information, his address and everything, the government now has, correct?
That's right. He, like hundreds of thousands of others, provided information to the government, which people involved in the program have confirmed now will be information that's available to President Trump and to his government, which he is committed to take a more aggressive approach that when it comes to forcing people to leave the country.
So what exactly has Trump said about this specific DACA? What has he said about repealing it, addressing it? How specific has he been?
He said that he's going to end it. He said that he's going to end it and other executive moves by President Obama on day one. What remains to be seen is how literally and how specifically he chooses to keep that pledge. And of course, if he does, if somehow he can be swayed by others, including people in the business community, to change his view. Among the questions is whether he would revoke immediately, instantaneously, all of the work authorizations, meaning someone who was legally employable one day would be unemployable the next day, or whether he would allow them to run out. And also, how much of a deportation risk there will be for people who previously were protected by DACA and, as you said, have provided information that, if the government chose to, would make it easier to track them down.
Up next, why Elon Musk is the target of fake writers on the internet.
And how IBM is preparing for cyber warfare.
Welcome back to Bloomberg Business Week. I'm Carol Masser.
And I'm Oliver Rennick. In the technology section, the trolls that Elon Musk thinks are behind the many internet complaints and mysterious attacks online.
Here's reporter Paul Barrett.
Paul, let's begin by talking about Shepard Stewart. Who is he?
Well, he's a fake op-ed writer. His byline appears on websites, particularly politically conservative websites, and whoever is behind the Shepard Stewart identity is very much intent upon criticizing Elon Musk, the very well-known tech entrepreneur and mogul who is affiliated with companies like Tesla and SpaceX. He has some enemies out there in the world who want to attack him but don't want to do it in a straightforward way.
Specifically, you delve into one sort of corner of the internet, which is largely, it seems like, opposition that he faces from an industry-specific standpoint, meaning people that may not, whose best interests may not be aligned with Elon Musk's. Tell us about where these people are from.
Right. Well, my strong suspicion is that his commercial competitors, perhaps at a couple of levels of remove, have hired firms who maybe have hired firms who are going out, putting websites up, hiring fake op-ed writers, and so forth. But I was not able to connect all the dots so that I can tell you that it's the coal industry that is behind this particular thing. Now, in some instances, you can identify what group is behind a website. There's a website, for example, called Stop Elon from Failing Again, which is a relentlessly negative website that portrays him as someone who just sucks up federal subsidies and does nothing in return for it. That website is affiliated with a conservative group, and that group, though, is a 501c4 group, so it doesn't have to disclose its donors, so you don't really know who's providing the money for, Stop Elon from Failing Again.
Are they making up stuff?
Well, for the most part, they are aggregating stories with bad news about Musk's companies, and the companies have had a kind of rocky up and down history. And in addition to that, you get these sort of mock editorials. So are they making stuff up? It's just very, very negative opinions about everything he does.
Right.
I mean, his companies have received certain types of incentives from government at different levels. That's a fact. Is that a terrible thing, or is that smart policy, for example, to encourage solar energy through his company Solar City? Well, and of course, he's not the only person in the solar industry who's receiving those incentives. That's a matter of opinion, except on these sites and with these writers, the opinion is always negative.
Also in the technology section, Mike Riley takes a tour of IBM's home for cyber war games.
Mike, help us understand the not so easy to understand world of preventing cyber attacks, hacking, and exactly what you looked at in the story that is happening right now to prevent this type of stuff.
Yeah, I mean, I think that there's an increasing awareness among corporations and major companies that a large breach, like we've seen at companies like Target or Sony, or basically pick your big hack of the last few years, can be a huge and brand damaging event. But it's not one that the C-suite or the parts of the teams and corporations that don't normally do security are really prepared for. So if you take, for example, Target, that was a hack that it had a big breach that happened around Christmas time. Turns out after they did an investigation that the company itself had overlooked some warnings that could have prevented the whole thing. By the time that all leaked out and there was a couple months of coverage of it, the CEO ended up resigning. So I think what's going on in Cambridge is IBM has taken the initiative to try and create a simulator. I think the analog is like a pilot simulator that you can put in a bunch of the characters that would be involved in a big breach, like a CEO or general counsel or the security team itself, put them all in a room and run them through a very complicated scenario that sort of illustrates what a company deals with when it deals with a massive breach, and just see what happens.
Well, what's interesting is, and you write about what IBM is doing, and specifically they've set up a cybersecurity training center. It's not just about the technology, but also about the crisis management after there is a hack. You went and visited, I'm assuming. Tell me what they're doing, what you saw.
Yeah, no, it's pretty impressive. They spent a lot of money creating an environment that can very realistically create not just the conditions of an actual breach, but then all the things that happen afterwards. So they've got this amazing kind of technology that can create all the sort of traffic that goes along with a corporate network. So they basically can simulate all the traffic of a major corporate network, and so you can have the security team in that room trying to figure out what happens after a phishing email is opened, or trying to track down a hacker in real time. But then they have all of these other things that allow sort of basically put the rest of the management team through its paces. So they'll have this sort of beautiful room that's got a huge screen on the front of it. This technology that comes from Hollywood, and they've got a studio where they can do mock interviews upstairs. Huh. Basically, they'll sort of start throwing things into the mix, like a leak to the press, or an SEC investigation, or an FBI investigation, and just see how the team handles it.
Up next, the psychology why more women don't come forward to report sexual harassment.
Welcome back to Bloomberg Business Week. I'm Oliver Rennick.
And I'm Carol Masser. You can also listen to us on radio on Sirius XM Channel 119. Also on AM 1130 in New York, AM 1200 in Boston, 99.1 FM in Washington, D.C., and AM 960 in the Bay Area.
And in London on DAB, MUX3, and in Asia on the Bloomberg Radio Plus app.
In the features section, a three-part look at sexual harassment, how companies try to fight it,
why more victims don't come forward,
and how victims describe harassment in their own words. Here's reporter Claire Sedith.
Sexual harassment is something we have talked a lot about as a country recently. The first thing that hit the news, obviously, was Roger Ailes at Fox News when Gretchen Carlson sued him. Recently, Megyn Kelly, her book alleges that he had made advances against her about 10 years ago, and she never said anything until Carlson sued. And then on top of that, President-elect Trump has been accused of also harassing or groping women, and he has been caught on video actually saying that himself. So I sort of wanted to look at the state of harassment in the workplace specifically, and, you know, why, despite decades of laws, lawsuits, high-profile scandals, people's careers have been ruined over this, why this is still so common. I was actually very surprised at what I found.
How did you find all of these women? I know some of them are connected to some cases that have played out, certainly in the media. but some not.
Yes. So some of them have sued their employers or past employers, I suppose. And so I found them just through, looking at old news articles. And then I just, put a call out for this. And I had friends of friends, complete strangers contact me online. It actually ends up being much easier to find people than you would expect. I received an absolute flood of responses.
That's what I wanted to ask you. How many people, once you put out, hey, does anybody know of anybody who's been sexually harassed? You got a lot of responses.
Yeah. And I mean, I had, this is just sort of anecdotally, but that I had friends who are not at all in the story, but tell me things that I didn't even know, and we'd been friends for years. And I, have been a reporter for over 10 years now, and I've never gotten a response that I have from this article.
You mentioned sort of the surprise that was inherent in putting this story together. Tell us about that and what you saw as sort of the biggest takeaways or the things that kind of took you by surprise.
Well, so I'll back up a little bit. To understand sexual harassment, it's such a broad term. It was coined in the 70s, and it was meant to just mean all the ways that women were made to feel uncomfortable at work, from leering to groping to actual propositions for sex. Women who were told that if they didn't submit to this sort of stuff, they would lose their jobs. But from like a legal perspective, that's like very, very broad, right? So what I was sort of surprised at is they essentially, over the years, the courts have cut it down to a couple of things. One is quid pro quo, which is essentially you do this or you lose your job or you don't get a promotion. And I thought that was sort of the Mad Men era thing that didn't happen very much anymore. But that's actually what Gretchen Carlson had accused Roger Ailes of. They've settled out of court. So he has never, I think, admitted to it, but it is done now. And then I thought, well, maybe that was just an unusual situation. And I talked to attorneys and women, and it turns out that still happens. It's usually women or anyone. It could be men too. About 16% of harassment claims are made by men who don't have the sort of power in their job that maybe you or I have. So a lot of service workers, farm workers, that sort of thing. And obviously it can happen at major establishments as well. So I was surprised by that. Then there's also something that we call a hostile work environment, which is, nothing, you're not necessarily going to lose a paycheck or lose anything, monetarily, but this is just the general sort of atmosphere that you have to work in. And that is what a lot of women complain about. Most of complaints today are hostile work environment.
And it's interesting. I think most big companies certainly have policies. And a lot of companies in general have policies. And yet the way employers deal with it, I felt like through your examples, some can be very supportive of the women who are, making the claim. And some are not.
Yeah, well, so if you pick any company, just off the top of your head, anything, you can find a policy that says they have absolutely no tolerance for harassment. Some of them stick to that policy, some of them don't. And the way that I have sort of thought about it and described it to people is, when someone asks you, what's it like where you work? You don't say, well, according to our employee manual, we have this, this, and this, and this. You talk about the people that your boss made you do recently that you didn't like, the weird person in the mailroom, all that sort of stuff. And that's what really makes the company culture. And so that's what women think about when they decide whether or not they're going to come forward. And that's actually sort of the real unstated companies.
So what is it about the sort of the loophole here that has emerged, where even though these policies are instated and they're on paper, they don't quite get enacted?
Some
is it because
companies just don't take this seriously at all? And I talked to women who had, very egregious violations happen to them, and nothing really happened. But I think to give companies the benefit of the doubt, I think most of them know this is a problem culturally and do want to do something about it. But when it's brought to their attention, one, it is unfortunately most of the time a he said, she said situation. So they're faced with potentially firing someone over the fact that over something that they don't have any proof about.
Bloomberg Business Week is available on newsstands now.
And also online.
All right, Carol, favorite story, politics?
Yes, how'd you guess? Opening remarks, I like the story that looks at autocrats. We're trying to figure out what type of president Donald Trump will be. There's no background. He hasn't governed before.
Yeah.
So we look kind of to some of the developing markets where there have been, to some extent, autocrats elected. And these are people who, like Donald Trump, have won kind of on their personality, on their charisma, if you will.
Not so much political background.
No, not at all, and have kind of controlled the media. And so it kind of breaks that down, and I thought that was kind of fascinating.
Yeah, me too. I like that.
How about you?
I think I'm going to go with IBM in the tech section, just because it was kind of from all the politics stuff, looking at how companies can prepare for cyber attacks. This is obviously going to be a huge part of the market. IBM buying up these companies, this little warfare center, it almost sounds like it'd be a fun place to visit.
Yeah, exactly. It's really fascinating. All right, everybody, more Bloomberg Television starts right now.
We asked some of the best minds in the world, from business, government, the arts, academia. What are the most urgent problems facing humanity? And how do we solve them? The result is big problems, big thinkers.
What is the number one major problem facing mankind?
I think it's a lack of education.
Politics has been getting dumber and dumber. You're dealing with a balance of greed and fear. If we don't find a more sustainable way.
Everybody has the capability of making a difference.
Remember your humanity and forget the rest.
Welcome to Big Problems, Big Thinkers. I'm Terry Blair. In this confront the most dangerous challenges facing our survival as a human race: climate change, economic dislocation, nuclear proliferation, social unrest. And we examine each issue by asking if there's an ethical framework that can help us face these problems and solve them. To do that, we'll hear from an extraordinary group of leaders as they search for answers and perhaps inspire us collectively to take action. In this first episode, all of these exceptional men and women agree that climate change is one of the top threats to our existence. Will we be up to the challenge? Will we take action?
When I was born 70 years ago, there were just slightly over 2 billion people in the world. And now there's almost 7 billion. The number of people on the planet has increased by 3.5 times in the life of one person. This has never happened before.
I often telling my Indian friends and also Chinese friends, I say, combine these two nations for over 2 billion. For 2 billion car, oil or pollution or these, unthinkable, unthinkable. So the existing economy system is not sustainable.
You have to think of the fact we've only got one planet. So we should treat
the planet is a non-renewable resource, and obviously the more people we have, the more strains we put upon the planet.
I've argued our planet is getting hot, flat, and crowded. And that means basically is that on the one hand, it's getting hot. That's global warming rising. We know that that's happening. But it's also going to happen faster because it's getting flat. That means more and more people, from an American point of view, can see how we live, aspire to how we live, and live like we live. And that means more and more people living in American-sized homes, driving American-sized cars, eating American-sized Big Macs. If we don't find a more sustainable way to satisfy those aspirations of all these people who want and now can have our lifestyle, that's a wonderful thing. But if we don't do it in a more sustainable way, we're going to burn up, choke up, heat up, smoke up this planet. And that itself will drive a myriad number of problems.
The greatest threat facing humanity today has to be climate change, followed by the possibility of nuclear war, because those are the only two things on the horizon that could destroy all of humanity. Today, people see droughts where they never had them before, floods where they never had them before, storms where they never